The economy doesn't feel that strong, yet the Fed seems to be responding to that.
Everywhere I look, I see more inflation, not less inflation.
We're pricing in a stronger U.S. economy for longer.
Economic paralysis isn't really our outlook. We think we're going in with significant momentum.
The economy's been resilient, and it demonstrates that it might be able to continue to grow right through the end of the decade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday on a 3-day winning streak on the S&P 500, following the best day for equities on the S&P, the Nasdaq, the Russell since November 6th. We had some weight to the rally. Futures up by 1/3% on the S&P 500, up by 0.4% on the Nasdaq. The next stop, earnings this hour from Bank of America, next hour from Morgan Stanley, and after that, the data 8:30 Eastern Time, retail sales and jobless claims. At 10:30, perhaps a policy preview. Scott Bessent, Treasury Secretary Designate, going on Capitol Hill.
This is going to be really interesting. So I think we're going to get some more details and color of actually what the economic policies are going to be for Trump 2.0. We do have some of his prepared remarks. He is expected to say that we must secure supply chains that are vulnerable to strategic competitors. We must carefully deploy sanctions as part of whole-of-government approach to address national security requirements. That sounds like that's going to get a lot of bipartisan support. And then critically, he says we must ensure the U.S. dollar remains the world's reserve currency. We've heard this from before from President-elect Donald Trump, so it's really no surprise that Scott Bessent's going to say this. Paul Donovan of UBS has this to say in his morning note previewing this. They will likely sound reassuring, Scott Bessent, on trade taxes, but the bigger question is whether Bessent matters on trade tax policy, that's what he calls it, or any policy. Jonathan, a single social media post can change market expectations.
It's just amazing how much hinges on the incoming administration, and that influence, the consequences of it stretch far and wide. Check out this reporting from our team here at Bloomberg overnight out of Japan. BOJ officials see a good chance of an interest rate hike at the next meeting. So long as, and here's the so long as, the arrival of Donald Trump at the White House, Danny, does not trigger too many negative surprises.
You want to talk about reactive central bank policy? This is it. We have a BOJ decision on Friday of next week. They might not have in hand what they're going to do until Wednesday or until Thursday. That's not least to say, even what we get on Monday might not be the final product of what we know for Trump. I don't know how you price in, let alone what tariffs will look like and the consequences of tariffs for these markets and for central bankers like the BOJ.
We said this yesterday. There's 3 big stories this month. It's a 3-part story. Payrolls was one piece, CPI was another. The third piece of it, the biggest data point of the month, comes on Monday, inauguration.
Last night, Mike Waltz, President-elect Donald Trump's incoming national security advisor, was asked by Brett Baier on Fox News about really how many executive orders are going to be. And he laughed and he's like, there's going to be a lot. Donald Trump's hand's going to start to hurt him, and he said there's a lot to roll back. You can expect these executive orders on things like immigration, potentially, Jonathan, one on TikTok to save this deal, things on energy. Where he comes down on tariffs, we still don't know, because there's 2 competing factions within this incoming administration.
At the moment, though, the mood has improved. We had solid earnings from the financials yesterday from the banks, including JP Morgan, Wells Fargo, and the likes of Goldman Sachs. And then we had a downside surprise on CPI. We've also had a better outlook from TSMC, which Danny's given equities a little bit of lift this morning.
It just shows how AI is this tide that lifts everything. Even if you have Apple sales look like they're declining, even though mobile is so big with TSMC, because we're all using so much more AI, it's this thing that can really save their earnings. But again, how much of that matters when it's the macro rally that's carrying everything? I think yesterday and even into today, this is the thing that matters. It's this tennis match where the narrative keeps going back and forth. I think we just got to wait till next month's NFPs, and I'm sure we'll have a new narrative.
Stocks positive this morning. We'll wait and see. We're up by 1/3% on the S&P 500. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth as equities have raised their losses for 2025. Stephen Cook of CFR as Israel and Hamas reach a ceasefire deal in Gaza. We'll see if that holds. And Chris Marinac of Janney Montgomery Scott on the bank earnings. Bank of America a little bit later this hour. We begin this hour with stocks looking for a 4th straight day of gains following their best CPI day since 2023. Cameron Dawson of NewEdge Wealth writing, the market reaction, stocks and bonds ripping together, showed how much pent-up concern there had been about a hot economy. This print supports a hold by the Fed and reduces the risk of rate hikes. Cameron joins us now for more. Cameron, good morning.
Good morning.
Good to see you. Are we relieved that we're just not getting rate hikes anytime soon, or encouraged by the prospect of rate cuts? Because there is a little bit of a difference.
There is a difference. I think taking rate hikes off the table certainly did help. If you looked at where the 2-year was trading at 4.4%, we think that that was pricing in some chance of a rate hike. Remember, the current Fed funds rate is at 4.5%. So taking that off the table does help. Then adding in some cuts does help at the margin, but we do think that this recalibration period of Fed policy is likely over. This idea of the cuts that we've done have been because we can. We think that the next round of cuts will likely need to come because they should, meaning that you need to see weaker economic data, you need to see an uptick in unemployment, likely to get more than just one, maybe two more cuts.
We'll get another read on the economic data at 8:30 Eastern Time. The big data point, we've said it repeatedly on this programme, is Monday, inauguration. What are your underlying working assumptions on what we will get in the first few weeks from the incoming administration?
Probably the better the stock market does, the more we get of those kind of negative things that could shake us, meaning that the more resilient we are going into this, maybe the more emboldened they feel that they could deliver more aggressive tariff policy, which of course continues to be the wild card. And we do know that people are anticipating tariffs going into this year. We've seen it in some of the buying behavior. We've seen it in some of the surveys, people saying it's a good time to buy durable goods because they're trying to pull forward some of that demand. So it's a really big question of how much we're already seeing the potential for that distort some of the data.
How resilient do you expect these markets to be with those announcements? Do you expect them to give Donald Trump and his administration the room to do those things?
Well, with credit spreads at 20-year tights and the S&P 500 trading at almost 22 times earnings, there's not a lot of cushion to absorb bad news, which is one of the reasons why we think as we go through 2025, we'll have this wide and choppy range. If you were trading at low valuations, you can absorb a lot of negative news. But when you are all in and positioning and valuations are high, it just means that there's just a lot less cushion.
Well, to that point, Jim Bianco made the point yesterday that I thought was fascinating. We were 0.002% away from having a core CPI that was in line, rounded up to being in line. In other words, we were 0.002% away from maybe an unchanged day on the S&P 500. That is some extreme sensitivity, Cameron.
It most definitely, and even potentially a down day, because it could have emboldened this idea that inflation is not moderating and that it could have emboldened the Fed policymakers in order to talk about potentially not having hikes on the table, but not delivering those cuts. So we're at this razor thin margin. But again, because you were pricing in some probability of hikes into the short end of the curve, we think that's why you saw such a powerful reaction.
Cameron, is the market too resilient that if we don't get some of these policy promises from the incoming Trump administration, that we're going to see big moves to the downside?
We think that's a risk. So the title of our 2025 outlook is Great Expectations. And one of the key components of that is that we think the market's pricing in just the right stuff coming out of D.C., meaning that we get all the things that are good for us. We get tax cuts, we get regulation changes, we get an M&A boom, but we don't get the things that could be potentially disruptive. And we do think tariffs and immigration policy are potentially disruptive. One of the things that led to such strong growth in 23 and 24 was an influx of low-cost labor. Labor supply going up was great because you were able to bring down wage growth without seeing layoffs. If that starts to change, where you lose this source of low-cost labor supply because of immigration, then you could start to see wage growth pick back up, and that could be a source of inflation. We don't see it yet, but that's a wild card risk.
TCJA is already priced in, at least the extension. But do you think we can actually get an even lower corporate tax rate?
That's not in our base case. The House majority is just so slim, and given the fact that you have to fight over $5 trillion of extensions, and you have this funding challenge, we can't forget that Bessent is going into this with a big bills problem. Over 20% of the Treasury supply right now of existing Treasuries is in bills. We've already had the reverse repo drawdown. What does that mean for how they're going to fund these big deficits? We think that's a huge question for Bessent that remains very much unanswered.
Do you think they can term out the debt? Any reason to believe they could?
I think the third quarter of 2024 would suggest that they can't right now. Look at what happened when Yellen just slightly increased the coupon bond issuance at the long end, and we saw a 100 basis point move to 5% in the 10-year Treasury yield. Given where we are today, if Bessent were to come out and say we're going to increase coupon bond issuance, I don't think the Treasury market would like it.
So perhaps a bigger question to ask then is whether you believe the fixed income market will constrain the ambitions of the policymakers in Washington.
It's very much a possibility. We think it's much less of a possibility in the U.S. because we are the world's reserve currency. We are the most liquid Treasury market. So as yields move higher, you do get some natural buyers that step in. But we think it is a very real possibility that the long end of the curve becomes untethered from what the Fed is doing, meaning that it's a big surprise that you've seen this big 100 basis point move in the long end of the curve despite the 100 basis point cuts in the Fed. And we think that that is reflecting some of these fiscal fears. So if the Treasury were to come out and say we want to term out debt, that could increase that untethering that has happened.
Is there not some of that that's happened already? Because there is this expectation that Scott Bessent likes longer term issuance, that he wants to term things out. Is any of that in the price yet?
Well, he said that when yields were lower, and he said that when he didn't have the job. So I do think that when they're looking at this challenge of saying we don't have reverse repo as a tailwind, we possibly won't have the Fed being willing to buy up these bonds through quantitative easing. We think that's actually a big wild card of how would the Fed interact with this. There is this challenge that he doesn't have a lot of wiggle room. So what's stopping bills as a percentage of treasuries going up to 25%?
Bond yields down aggressively yesterday, this morning, up by not even a basis point, a 10-year, 466. Cameron's going to be sticking with us. Cameron Dawson of NewEdge Wealth. Up next on the programme, we'll be talking about tariffs, and we'll look for Bessent's views on that a little bit later on today. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's bring in Yahara Hackers. Hey, Yahara.
Good morning, John. Israel and Hamas have agreed to a 6-week ceasefire starting this Sunday, a day before Donald Trump's inauguration. Under the terms, Hamas would release 33 hostages taken on October 7th, 2023, while Israel pulls out of populated areas in the Gaza Strip and releases hundreds of Palestinian prisoners. But even before the deal is implemented, Prime Minister Benjamin Netanyahu's office is accusing the Iran-backed group of reneging on parts of the agreement and says Netanyahu's cabinet won't meet until Hamas accepts all points of the deal. Meanwhile, some respite in Los Angeles. The low humidity and dry winds that have fueled the wildfires are forecast to end by midday today, but a lack of rain and another round of winds are forecast for next week. The two largest fires, the Eaton and Palisades, have become among the most destructive in California history, leaving at least 25 people dead and scorching more than 37,000 acres. And Bank of Japan officials think it's likely they'll raise rates at their next meeting. Sources telling Bloomberg it's likely the central bank will hike rates by 25 basis points next week unless Donald Trump ruffles markets or changes expectations about the global economy at the start of his presidency. Quite the caveat. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Dollar yen right now, 155.78. Up next on the programme, Scott Bessent heading to Capitol Hill.
I think everyone is on board with a kind of forward guidance or a phased-in tariff. If you bring down your tariffs, we will bring down ours. Everything that I've seen assumes that there is a jump on day one, which will not happen.
Will it happen? That conversation up next. Live from New York City this morning. Good morning. Three-day winning streak on the S&P 500. Let's see if we can make this day 4. Equity futures, so far so good. On the S&P up by 0.28%. Lots to get through the hour. Earnings from Bank of America, then numbers from Morgan Stanley before we get some data for you. Retail sales and jobless claims at 8:30 Eastern Time. Under surveillance this morning, Scott Bessent heading to Capitol Hill.
I think everyone is on board with a kind of forward guidance or a phased-in tariff. President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. If you bring down your tariffs, we will bring down ours. Everything that I've seen assumes that there is a jump on day one, which will not happen.
So here's the latest this morning. President-elect Donald Trump's pick for Treasury, Scott Bessent, facing his confirmation hearing on Capitol Hill. Bessent writing in prepared remarks, "We must secure supply chains that are vulnerable to strategic competitors, and we must carefully deploy sanctions as part of a whole-of-government approach to address our national security requirements. And critically, we must ensure that the US dollar remains the world's reserve currency." Bloomberg's Mike Shepard joins us now for more. From the nation's capital in Washington, D.C., Shep, let's start with trade. What questions do you have that you would like to be aimed at the Treasury Secretary-designate later on today?
Well, he's talked about the tariffs in relation to China there, John, and signaling that there could be a gradual approach. And that is something he said back in August. And it aligns more recently with a great scoop from our colleagues, Saleha Mohsen and Jennifer Leonard earlier this week, saying that a gradual approach could be something that his advisors have on the table. I'm curious about what he says about the tariffs that Donald Trump has threatened against U.S. trading partners, Mexico and Canada. We've talked about that a lot on this program and what that could mean for relations between the closest to U.S. neighbors and largest trading partners. Trump has threatened those over border policy issues, not so much economic issues. And we're already seeing Canada just last night preparing a list of countermeasures that it would deploy if Trump unveiled those tariffs. So what would he have to say about that? Cameron also talked about bill management. That would be an interesting question for lawmakers to bring up. It might be a little bit more in the weeds. And then also tax cuts. How does he see that getting through? And will he make the call for cutting corporate rates all the way down to 15%, as we heard Trump put forward during the campaign?
Shep, this is a hedge fund investor. So when he talks about tariffs, he knows the implications for the S&P 500 and what that could be. But he also knows that he has maybe an audience of one, and that's the incoming president, Donald Trump. So how does he walk that fine line?
That's a great question, Anne-Marie, because this is what got Scott Bessent the job, in essence. He is the point person for Trump's America First agenda on the economy. And he was able, during the transition and even before that, to demonstrate to both Trump's diehard MAGA allies and to Wall Street that he is the best person for this job, that he actually has Donald Trump's ear and can get the president to maybe move off course if needed. But Donald Trump is somebody who really likes to stay his own course when he sees something he wants. So that will be a tricky task for him. We did see his predecessor under Trump, Steven Mnuchin, last 4 years by successfully navigating all of those pressures from outside the administration and then, of course, from within, especially from the boss.
Well, Shep, we know another big part of this job is engagement abroad. Yellen frequently speaking to counterparts in China and elsewhere. How do we expect the questioning to evolve and answers we might get from Scott Bessent? As we know, Trump has been very vocal, not just about adversaries, but allies as well.
You know, Dana, we did get an early taste of how he views this whole question of economic diplomacy. And he talked in the prepared statement that we referred to at the top of the discussion now, where he sees the importance of maintaining a strong and robust sanctions regime, but one that is perhaps a little more coordinated. And he also is emphasizing that he would want to see the dollar, the greenback, preserved as the world's reserve currency. It's come under some pressure, thanks in part to those sanctions programs, which have called into question for allies and adversaries alike the value of the dollar, given that there are so many political pressures here in Washington and geopolitical pressures generated by those sanctions programs. So this will be another line of questioning we will want to see unfold and learn a little bit about in terms of his ability to carry out economic diplomacy for the incoming Trump team.
Hey, Shep, appreciate your time. Looking forward to this one a little bit later. Bloomberg's Mike Shepard there on the latest as we look for that grilling, that hearing with the Treasury Secretary-designate Scott Bessent. One of his biggest positions in the hedge fund a number of months ago, what was it?
Gold.
It was gold. And it was gold. And why? The way they've managed the sanctions issue. This is a guy that's sort of got the levers of government now and can start to think about how to influence things.
He has the levers of government. He also put on two of the most historic trades in the financial community, one of them breaking the Bank of England alongside Stanley Druckenmiller when he worked for George Soros. But he had that gold position because, remember, we talked about this Mohammed El-Arian. He didn't call it de-dollarization. That went too far for Mohammed. But it was this idea of the depreciation of the dollar on the margins because of how many sanctions are just levied against the world right now. And what a lot of people will tell me is Sanctions don't work. They just create new markets.
Cameron Dawson of NewEdge Wealth is still with us. Cameron, let's talk about tariffs. This is what Scott Bessent said to us back in August. Everything I've seen assumes that there is a jump on day one, which will not happen. How much capacity do we have to absorb some bad news next week if it does happen?
Well, as we talked earlier, I think given where valuations are and given where earnings expectations are, there isn't a lot of capacity, meaning that if you were to get a big jump on day one, what would that do to the dollar? We typically have seen a strong dollar in the face of tariffs because it reduces export trade activity. If you see the dollar spike even further, that could be bad for U.S. corporate earnings. We heard from the European luxury guys this morning, and their earnings were great. They're enjoying a strong dollar. They are enjoying a weak currency.
Richemont's flying.
It's absolutely flying. So if we hear from U.S. companies, though, they're likely to talk a lot less nicely about a strong dollar. So if you see a big uplift in tariffs, that would be the risk to U.S. corporate earnings.
Do you expect that to be a theme for this earnings season already as these numbers start to come through?
I think that it is a really good scapegoat for potentially talking down numbers. We've only heard from the banks, which don't have the same kind of currency dynamics. Once we start getting into more of the consumer companies, those that have a lot more exports, the manufacturing companies, it's likely that they use the dollar as an excuse to say this is why we might have been seeing some softer sales, as a way to talk down guidance. Now, maybe that's an opportunity to jump over a lower bar through the year, but we do think that that will be the scapegoat.
Well, as you say, we're priced to perfection, so we're sensitive. What about Europe, though, that has been lagging behind the U.S., where the bar perhaps for good news is lower?
Valuation is not a catalyst, and sometimes value traps do very much exist, and Europe has been a value trap effectively for the last 14 years. It's been persistently underperforming the U.S., and we think it's less about valuation, it's more about earnings dynamics, and the fact that European indices tend to lead more towards old economy. They don't have the same kind of tech dynamism that has driven U.S. earnings. So until we start seeing an inflection in those kind of old economy earnings that relies on a weaker dollar and likely a commodity cycle, without those two things, really hard to be structurally bullish on that area.
I'd say one thing that surprised me yesterday, though, with the rally everywhere was the DAX hitting a new record. So there are pockets that have been doing well in Europe. Are you looking for any of those pockets, or is it just overall it's a market you don't want to touch?
No, we think selectivity works really well within international markets because it's just much less concentrated. It's really hard to beat the Russell 1000 Growth Index when the top 10 names are nearly 60% of the index. So when you have something like international markets where there's a lot bigger difference between winners and losers, selectivity actually sets you up for better alpha generation or outperformance.
If we can go back to tariffs and winners and losers, last night we have reporting from our colleagues in Canada that they're drawing up a list of what will be the retaliatory measures. The fact that if we have just the tit for tat between the United States, Canada, United States, China, United States and Europe, how much is that in itself going to dim economic growth?
It's a big risk because we did see that if you look at the data in industrial activity going out of the tariffs in 2018 and 2019, it dipped down. We don't know what it would have done in 2020 because we had COVID that hit, but we did see this industrial recession, or at least a slowdown in the face of tariffs. And there's also this notion that tariffs aren't inflationary, but for those areas that did have tariffs applied back then, prices did go up. It was masked by deflationary moves and things like oil prices back in that time. So we think that there's a lot of potential disruption if you see them applied broadly, given the experience that we had in 18 and 19.
You mentioned Mohammed. Mohammed's talked about this. There are people out there who think maybe we get this one-off price shock. Mohammed's made the point that companies aren't going to wait around this time around. They're going to pass on these price increases pretty quickly.
You could argue that they already are not waiting around. They're already starting to pull forward some of the imports that they're bringing in. Not to mention, even beyond tariffs, a lot of these companies are expecting demand just to all of a sudden be lifted by the animal spirits. The NFIB Small Business Survey showed that they expect sales to pick up pretty dramatically. So across the board, you might be seeing all these companies bringing what they think is going to be the effects of Trump this year forward.
We mentioned Europe briefly. In Paris, France today on the CAC 40, we are higher by about 2%. Expectations in Europe are rock bottom. So only a little bit needs to go right to engineer big moves. Check out Richemont, up by close to 17% this morning. LVMH is up by close to 10%. Those luxury players are ripping.
I think this is important to note because we talk a lot about the valuation difference between the U.S. and Europe. But if you take the top winners in Europe that are exposed to U.S., that valuation difference shrinks a lot.
big time. Equity futures this morning up a little bit as well, anticipating more bank earnings. Later this hour, we'll have numbers from Bank of America. A special thanks to Cameron Dawson of NewEdge Wealth. Up next, Stephen Cook of CFR on the Gaza ceasefire deal. From New York, this is Bloomberg. Equity futures on the S&P up again by 0.2%. On the Nasdaq 100 up by close to 0.5 on a three-day winning streak on the S&P for the first time through 2025 so far. Let's see if we can make it day 4. Yesterday, the biggest one-day gain on the S&P, the Nasdaq, the Russell since November 6th. You remember that day? The post-election day Trump bump. It was that big in yesterday's session, and it was due to this move in the bond market. Double-digit decline on a 10-year yield. Important off the back of a softer than expected CPI print. The 10-year this morning, 465.93. That move, unlocking some dollar weakness. Let's check out the FX market together. Check out dollar yen right now. That's the one to watch, 155.76. We're negative by 0.4%. That's a stronger Japanese yen and more rumors, more reporting suggesting that the BOJ is about to hike again.
If they get what they need from Donald Trump. And that is no disruption to financial markets. That's what our reporting suggests. It shows just how everything hinges on the U.S., not just the economic data coming in, but also the government. I think it's important to keep in mind that until 8:30 a.m. yesterday morning, the narrative was that the U.S. cutting cycle was over, and that would hamstring all of our international partners. That has changed so rapidly, and again underscores the fact that it could change rapidly again.
It could change again Monday morning. The day after that, when we start to get some executive orders from the incoming President Donald Trump. Could change this morning. Retail sales and jobless claims at 8:30 Eastern Time, 2 hours away. Under surveillance this morning, TSMC projecting better than expected quarterly sales and capital expenditure, expecting to spend about $40 billion on technology and capacity this year, up to 19% more than analysts had anticipated. That stock is up by 5%, and a lot of other stocks connected to this are up in sympathy.
It just shows how big AI is at the moment. And this is what I come back to. The CEO talked about this idea that smartphone unit growth will be in the low single digit. You think that would be bad. You think that would be bad for their chip sales. But all these phones are incorporating AI into their phones, which means more chips. They also want to be on the leading edge of technology, which means selling more chips. Also, advancements are happening so fast that presumably the turnover cycle is quicker, meaning more chips. So that, plus restrictions on China from the U.S., it is not hurting TSMC.
It's another reason why the mood has lifted in the past 24 hours. I talked a little bit about the data later, 8:30 Eastern Time. One to watch later on this morning as well. This one right here. President-elect Donald Trump's pick for Treasury Secretary Scott Bessent heading to Capitol Hill today. His Senate confirmation hearing kicking off at 10:30 Eastern Time. He's widely expected to win confirmation in the Republican-controlled chamber, but we're all looking for clues on policy initiatives across trade, T-bill issuance, all these kind of things and more.
And also taxes. And this is going to be a big one, especially for Democrats that want to talk about revenue raising and want to stop an extension of TCJA. Some of them, not all. He is going to really frame this, according to his opening remarks, that Americans will face the largest tax increase in history if nothing at all is done with TCJA. Also likely, he'll be asked about some of the nuances we've been discussing on this program for months. Will they lower the corporate tax rate? A slew of policies. It's going to be very interesting, I think, between him and Senator Elizabeth Warren. It's going to be a lot of back and forth. A lot of this is performative, but likely this is an individual that is going to get Senate confirmed and sail through.
Must-watch TV. But I think for this bond market, the thing that is of the most consequences is anything he says about debt issuance. Because the other points you raised, they are extremely important, taxes and tariffs. But those could completely change with Donald Trump. Where Scott Bessent has more control and has more influence is whether he terms out the debt. And maybe you're already seeing some of that being built in. Maybe that's why the long end yields have already been rising. But for a bond market participant, I don't know if we're going to get questions or answers about it, but that's going to be what matters for them.
I think we know where they're focused on it, because over the weekend we heard from Vice President-elect J.D. Vance, and J.D. Vance brought it up at an interview a couple of times, totally unprompted, focused on the bond market. I'd also point out this name too, Stephen Mirren, who co-authored that piece with Nouriel Roubini on Treasury activism under the Treasury Secretary Janet Yellen. Stephen Mirren is going to chair the CEA. So that's one to watch as well.
Definitely. They are focused on this. Scott Bessent has been critical of Janet Yellen on this program, and he was just advisor to President-elect Donald Trump months before the election. I was really taken aback at how many times J.D. Vance brought it up in a very general interview when he was so concerned about that the interest payments on our debt is rising so much. 2024 is more than $1 trillion. 2025, it's going to be more than $1 trillion. How do you do that and try to be fiscally responsible?
The 10-year this morning, 466. The 2-year down a few basis points. We're down 2 to 428. Let's get to the latest on geopolitics. Doubts emerging about the Gaza ceasefire agreement. The Israeli Prime Minister Benjamin Netanyahu accusing Hamas of reneging on parts of the deal. Netanyahu's office saying new demands are an effort to extort last-minute concessions. Anne-Marie, you broke this story for us here at Bloomberg in the last 24 hours. What are you hearing now?
Well, what I would say is that there is going to be issues, of course, that arise. This is very difficult when you're dealing with Israel and Hamas, which is designated a terrorist organization. But what I have been told this morning is that they are resolving this snafu, this last-minute issue. But I would not say that all of this is going to be smooth sailing, crystal clear, because of how tenuous and difficult it was to get to this point. What we do know, though, is that the deal is in place, and we should be seeing hostages starting this weekend come out. I have been told about 24 of the 33 that are set to come out are actually alive, and this is just the first phase. When they get later into the agreement, in the second phase, potentially all those hostages could come out.
Jumana Basechi providing leadership out of the region for us from Dubai, and Bloomberg's Jumana joins us now for more. Jumana, what are you hearing? Because there have been some reports that this is close to breaking down already.
Yeah, well, it certainly is a bit of a backtrack versus where we were less than 24 hours ago. But to echo what Anne-Marie was saying, there appears to be an agreement in place. You wouldn't have heard from the Qatari Prime Minister. He wouldn't have given that press conference if he was not sure that all sides were going to agree to it. And you wouldn't also have heard from President Biden or even President-elect Donald Trump. So it appears to be the case of something going on within the Israeli cabinet, because they were due to vote on it at 11 a.m. local time today. They are postponing the decision, claiming that Hamas are reneging on some of the elements of the deal. Now, quickly after that, the leader of Hamas put out a statement on Telegram saying that they are actually committed to what was discussed with the mediators. So at this point, a bit of flux. But to go back to what our reporting suggests, the phase one of the deal is still very much going to be effective as of Sunday. That would secure the release of those 33 hostages that Anne-Marie was just talking about. Some of them thought to have died in captivity in exchange for Palestinian prisoners. And perhaps that is one of the points of contention that is being raised here, because there are certain factions within the Israeli government that are not so comfortable seeing the release of some of these prisoners. The likes of Yahya Sinwar at one point was held in Israeli prisons. He was released and obviously went on to be the mastermind of October 7. And just one other point that is proving to be somewhat of a sticking point as well, the gradual withdrawal of IDF from the Gaza Strip. Many don't want to see that happen without some certainty about who is going to be governing Gaza once the IDF withdraw.
Unfortunately, nothing's easy about all of this. Jumana, appreciate your time. Jumana Basechi there of Bloomberg out of Dubai. Let's extend the conversation. Stephen Cook of CFR warning the war is not over, writing, it is a complicated deal that will take months to fulfill, if it is ever fulfilled. This gives ample opportunity for the opponents of the deal to undermine it. Stephen joins us now for more. Stephen, welcome to the programme, sir. Looking forward to getting your thoughts on this issue. Just first of all, and I think it is significant, who do you think got this over the line? The sitting president or the incoming president?
It's a great question. I think that this is a deal that the outlines of which we are all familiar with going back to last May. But clearly, President-elect Trump, I should say, we have one president at a time, played a role here by sending his own envoy there and talking tough, not just to the Israelis, but also, I believe, the Qataris, in encouraging everybody to get this over the line. Of course, the Israelis have become exhausted in Gaza. Recent reports suggest that Hamas is recruiting at a rate that is even or greater than the number of Hamas militants that the Israelis can kill. And Hamas wants the deal so that it can say that it won. So there was a confluence of interests here, but undoubtedly, President Trump's suggestion that there would be, quote unquote, hell to pay concentrated in a number of mines in the Middle East.
Stephen, that's what I've been told by a source in the region, that Trump was able to set red lines and then Steve Witkoff did some of the heavy lifting. I think a lot of people, though, and I've been talking to everyone about this, would say everyone deserves some credit. And actually, these two teams, whether it's Brett McGurk, Amos Hochstein, Steve Witkoff, Morgan Ortagus, actually worked together. And I've heard a lot of these people actually give the other side some credit. But if Steve Witkoff and Trump was doing the heavy lifting on the end of this deal, likely that is to pressure the Israelis. What does this say about the Trump relationship with Benjamin Netanyahu going forward?
Well, I think the big myth is that Netanyahu and Trump have a really good relationship. In fact, throughout the 4 years of President Trump's first term, neither the president trusted Netanyahu nor did Netanyahu trust the president. They were each expecting the other to double cross each other. And during the elections that occurred, the Israeli elections that occurred during Trump's term, President Trump was rooting for Netanyahu's opponent, Benny Gantz. Netanyahu's tried to make up for this by calling the president-elect repeatedly throughout the transition. We know that President Trump was deeply annoyed with Netanyahu when he congratulated President Biden back in November 2020. So there's a lot of work to do between these two men. And I think that the president-elect was most interested in a deal. So this was not going to be a headache of his on the first day. And that's why he sent Witkoff to put the pressure on Netanyahu.
Biden yesterday, we heard from him, said during the next 6 weeks, Israel will negotiate the necessary arrangements to get phase 2, which is a permanent end of the war. Do you see a permanent end of this war?
No, I don't. And as you were remarking just before, this is a long and complicated process. Only in the 16th day of the first 42-day phase will negotiations begin on the terms of the second phase. Think about how long it's taken us to get to just this outline agreement, these 3 phases. In addition, throughout this long period, there is ample opportunity for opponents to try to undermine it. There's precedent for this in a much larger, longer period. This happened during the Oslo period in the 1990s. There are Israelis who are opposed to it, and people are focused on Bezalel Smotrich and Itamar Ben-Gvir. But there are members of Bibi Netanyahu's Likud party that are opposed to this deal. They've written him a letter and saying, don't put Israel's national security at risk. And of course, Hamas and extremists on the Palestinian side would like nothing more than to continue to suck Israel into a conflict, a never-ending conflict in the Gaza Strip, to further delegitimize Israel in the eyes of the international community. So there's very serious questions about implementation of this ceasefire. And of course, just think in broader terms, after this 15 months of brutal warfare, neither side is looking to bring this conflict to a final peaceful resolution.
Stephen Cook, appreciate your time. Stephen, thank you. Stephen, of course, of CFR. Anne-Marie, fantastic reporting throughout yesterday. By the way, congratulations for that. I think it is significant who helped it get over the line, because we could start to raise questions about how quickly other things could change with the incoming president.
Right. And I think a lot of the adults watching this play out that I speak to say, look, everyone gets credit, right? The deal, the parameters of the deal were put in place by the Biden administration. But Biden was a lame duck after the election, regardless of who won, Kamala Harris or Donald Trump. Yeah. So Benjamin Netanyahu was waiting for that. Who am I going to be dealing with? And obviously, it was Trump and his team. Trump immediately sent Steve Witkoff there and really put the pressure on the Israelis to get this over the finish line. So I think there's credit to be given out to both. But in terms of the heavy lifting, I've been told it goes to the Trump team.
Let's see if it holds. Let's see if it holds. If you are just joining us, welcome to the programme. Equity futures are positive. Bank of America numbers drop in very shortly. Before we get there, let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Heckers. Hey, Yahara.
Hi, John. Canada has drawn up an initial list of more than $100 billion worth of U.S.-made products that it would hit with tariffs if Donald Trump goes ahead with his threat to impose a levy on Canadian imports. Sources tell us the list is a draft and would come into play only if the Trump administration moves first. Prime Minister Justin Trudeau and the premiers of Canada's provinces met yesterday to plot a strategy for dealing with U.S. protectionism. Meanwhile, the TikTok CEO has joined the list of tech moguls attending Donald Trump's inauguration. The New York Times is reporting Xiao Chu has been invited to sit on the dais where former presidents and other important guests traditionally are seated. The app, owned by China's ByteDance, faces a Sunday deadline to find a U.S. buyer in order to continue operating in the country. Politicians from both parties are seeking ways to keep TikTok accessible in the U.S. despite the impending ban. And shares of Target are rising more than 2% in the pre-market. The company raised its guidance after holiday sales beat expectations. The positive news comes after Target profit guidance late last year following missteps on inventory and product assortment. That's Bloomberg Brief. John?
Ayahara, thank you. Numbers from Bank of America just out for the fourth quarter. Net interest income, better than expected. Upside surprise. Investment banking revenue, better than expected. Upside surprise. The stock up marginally after all these banks rallied yesterday. We're higher by 0.4%. Up next on the program, surging profits for the big banks.
Bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. A new administration that's going to be easier on regulations, and as a result of deregulation, the banks are going to benefit from that.
It's hard to disagree with that conversation. Up next. Equities doing okay. We're up for 3 straight days. S&P futures this morning up another 0.25%. Under surveillance, surging profits for the big banks.
I think the banks are very important. Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. The economy is growing, loan demand is growing. A new administration that's going to be easier on regulations, and as a result of deregulation, the banks are going to benefit from that. As a matter of fact, I think that the most obvious beneficiaries immediately from the new administration.
The numbers yesterday were good. The numbers this morning, they're good too. Bank of America's up by more than 2% with those numbers. Here's Marinac.
Jonathan, very comfortable beat for Bank of America, not just on the fourth quarter for net interest income coming in at 14.36. So that's a very comfortable beat, but it's about the guidance. For this current quarter in Q1, you're looking at 14.5 to 14.6. You then accelerate through to the fourth quarter of this year. So this is a progressive story on incrementally building on steeper curves on net interest income. By the fourth quarter, you're looking at 15.5 to 15.7. So that's the net interest story. In terms of the bulwark of the bank, fixed income, FICC, we saw pretty good showing yesterday for the others, 2.48 billion. That is a beat. Equities pretty much, I would say, at the money, if not just a bit lighter, 1.64 billion. The street had penciled in 1.69. And we're not in a hurry for provisions either. Provisions for credit losses, 1.45, Jonathan. That's less than expected. So you have 3 legs to the narrative of this stool from Bank of America, which is about steady and growing NII, a very well-functioning investment bank in terms of FIC. And as we've heard yesterday, this sort of low point of where we are in provisioning for a tougher time in the economy. One line from them is that the consumer client spending continued to grow at a moderate pace. Jonathan.
Marinac, thank you. The stock is up by 2.4%. Do they look good, these numbers, from where you're sitting?
They look more than good. Let me tell you something. They never really give this much of a guidance. And you're seeing Bank of America now saying not only are they going to make more net interest income, by the fourth quarter, they're going to be making $1 billion or more in quarterly net interest income by the end of this year. So that is how confident they are. This is due to loan growth. It's better deposit pricing. And it's also, remember, that roll-off of the securities that they held at low interest rates now going into higher interest rates. So this is a Bank of America sweet spot. They're also coming in with a lot of records at their trading desk, which shows they're still competing with the big guys here and keeping a handle on risk. We talked about this yesterday. The equity markets, you're seeing the banks take on a little more risk and maybe leave some dollars on the table because of it, because of the volatility.
I was going to say, usually in this earnings season, we disaggregate the Bank of America's, the more consumer-focused ones versus the Goldman Sachs. Now that we have Bank of America in hand, is there a clear advantage to either business model?
You know, that's the other sweet spot we're looking at. Main Street businesses are doing well, and so are Wall Street businesses. Usually you lean on one or the other, and Bank of America is showing that they're doing both.
Let's head over to Chris Marinac. He joins us from Janney, Montgomery, Scott. Chris, we'd love your thoughts on the numbers that just dropped from Bank of America. But for the numbers we saw yesterday as well, how much of this is just about a better environment for the banks? How much of this is about better execution?
John, I think the cost of funds coming down in the fourth quarter is going to repeat itself in the first quarter because we still have the full effect of the 100 basis point Fed cut that's going to filter through. So that's very good for net interest margins. again in Q1. That's where the guidance comes in for B of A being positive, not just for now, but also through the year. I think that the comment about Main Street doing well is 100% correct. I also think investment banking still has a lot to go in terms of the inflection point for it to get stronger. Had a very good quarter, as you could see. Asset management continues to be really well. That whole diversified model is playing out quite well. I think the point that we also see is that the overall credit quality continues to be very tame. Charge-offs and problem loans are not having any spike. We're not seeing any follow-through of commercial real estate problems. If anything, the profitability of B of A and all of these big banks is so strong, it allows them to solve their own problems internally. And I think you're seeing that come out in the credit data as well.
Mike Mayo of Wells Fargo, the bank analyst over there, made the comment yesterday that he hasn't heard Jamie Dimon this optimistic in decades. Chris, can you speak to not just the shift in numbers and the improvement there, but the improvement in sentiment among the banking executives?
Well, I think it all goes back to the regulatory shift that we're about to see. I mean, it's going to take 6 to 9 months to have all these new regulatory heads be confirmed and then really begin to do their work. But the outlook is incredibly positive. And we all know the market looks ahead 5 to 6 months. So that's where the bullishness goes. And I think the CEOs are part of that. I think Jamie has been unhappy about the regulatory setup for several years. And now that that starts to unwind, it really allows them to do more business. And this is true for every bank. It's not just the big banks. It filters all the way down to mid-sized, to community banks. It's very healthy for the industry.
But that's the good news of Trump 2.0 for the banks, this idea of deregulation, a tighter regulatory touch. And we've already seen some of that with Barr stepping down at the Fed. But what about things like tariffs, Chris? Is this going to become an issue for the banks?
Sure. I mean, we don't know what we don't know about how companies react to the tariffs. So that is absolutely a risk. I think we have to be vigilant this year about seeing banks continue to sort of keep reserves steady, to watch the C&I books. I think commercial industrial loans are going to be something to watch in terms of how credit unfolds there. It looks like fourth quarter is more of the same. You had very low losses at these big banks through this morning. But I think that is where the risk could shift quickly, whether it's tariffs, whether it's immigration, or just any other parts of the economy that filter back to banks.
Hey, Chris, at 7:30 Eastern time, we'll get Morgan Stanley. We'll see if we get the clean sweep. Every bank so far has delivered a beat. Chris, these are big banks, big institutions. Where are the regional players? Do they win too?
I think they do. I think you'll see some regional players out later today with M&T and certainly tomorrow with Truist. First Horizon is out with a good quarter this morning. I think next week after the holiday should be more of the same. I mean, cost of funds is the big factor of production for these companies. And because it's coming down in Q4 and again in Q1, that really does help the margin and the top line revenue for these companies.
Hey, Chris, appreciate your time. Chris Marinac there of Janney Montgomery, Scott. Shanali's still alongside us. Shanali, just give you the final word. Your takeaway from all these numbers and look ahead to Morgan Stanley, please.
You know, you look through the presentations and you look where the loan growth is coming from. This is critical. It means the read-through is not going to be the same across every bank. Page 8 of the presentation for those who are interested, it's commercial loans. It's not really consumer loans. In fact, consumer vehicle lending is up marginally. Home equity is flat. And so is residential mortgages are rising, which is kind of interesting. FICO scores, I love to look at this in the presentation.
What are they now?
For a consumer loan, it's 802. And for a residential mortgage, it's 775. So near perfect. It's telling you that not every consumer could get a loan.
If you're following along at home and you're not in the United States, 802 is like really, 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 really good. Like almost perfect.
I'm not an 802. I'll admit it.
I'm not going to say what I'm at. I lived out of the country for a while, so that impacted things. But it shows, again, it speaks to the good credit quality. And for all those people saying the consumer is falling off a cliff, it hasn't happened. And maybe there is some bifurcation in this, right? To your point, Shanali, that not everybody is getting a loan. But there's still so much strength in these earnings, be it from investment banking or be it from Main Street.
Shanali, appreciate it. We'll see you again in about 35 minutes' time. Morgan Stanley just around the corner. Every bank that's come out with earnings so far in the last 24 hours has beaten estimates. It's been a decent 24 hours. What's not to like? Bank earnings were decent. CPI was softer. Equity futures right now on the S&P 500 just a little bit firmer. Up next on the programme, David Lebovitz of JP Morgan Asset Management, Jessica Taylor of the Cook Political Report, and Francis Donald of RBC. From New York, this is Bloomberg.
Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. and they certainly do seem to be doing very well.
What the results speak to is the ability to earn into your valuation.
I think you're going to find that we're going to have robust trading results for all of the big banks.
It's going to be a great year to be an investment bank because I think you are going to get increased volatility in bonds and equities.
I think there's a lot of optimism about policy improving banks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures up again by 0.25% on the S&P 500. Ed Yardeni said it just then in that little clip. The banks need to do well. The banks are doing well. We've had a beat everywhere across the street. Let's see if Morgan Stanley can complete the clean sweep at 7:30 Eastern Time in 30 minutes. On the Nasdaq 100, up by 0.4%. After we get those numbers from Morgan Stanley, we look ahead to some economic data, retail sales and jobless claims. Then a really important hearing. Scott Bessent, Treasury Secretary Designate on Capitol Hill. That hearing kicks off at 10:30 Eastern Time. We've got to kick it off with Bank of America. These numbers look better than good. Check out this for a stat from the team here at Bloomberg. Investment banking fees jumping 44% in the fourth quarter.
And a lot of those are rates coming down, but also the animal spirits. It's remarkable. I'm going to be really interested to hear from Brian Moynihan and the team at Bank of America just how optimistic they are. The CEOs are optimistic, as are their clients. They've talked about all these corporate clients coming in and giving them loans, and the loan quality looks really solid too. All of these bank results show that some of their credit losses that they're setting aside much lower than what we expected.
And you've heard these conversations on the calls looking out to 2025. It's all about the incoming administration and the policy changes we might see. You might get some clues at 10:30 Eastern Time, and at 3 hours after that, when you hear the grilling that you're going to see down on Capitol Hill with Treasury Secretary Designate Scott Bessent.
Well, when you hear from these Wall Street executives, it's clear there's a vibe shift when it comes to deregulation. We talked about, though, with Chris Marinac just a moment ago, was there's still this uncertainty regarding what is trade regulation going to look like? What potentially is that policy going to end up winning out in the Oval Office? Who's going to win? And we're going to get a little bit more color potentially on how Scott Bessent and how he is going to advise the incoming president-elect on how he should be dealing with tariffs and negotiating these trade deals. But he needs to be careful. This is a veteran hedge fund guy who knows that anything he says on trade and tariffs has the potentially move this market.
I think he understands the game. I think we're all looking forward to the hearing a little bit later. Bank of America had a nice rally yesterday, up by 2.9%, following really decent numbers elsewhere. It's up again this morning by 1.6. Coming up this hour, we'll catch up with David Lebovitz of JP Morgan as stocks gain on the latest earnings news. Jessica Taylor of the Cook Political Report as Treasury pick Scott Bessent heads to Capitol Hill, and Francis Donald of RBC as markets reprice rate cut bets. We begin this hour with stocks higher, investors breathing a sigh of relief as bank earnings come in stronger than expected and inflation comes in softer than expected. David Lebovitz of JP Morgan writing this: as inflation gradually moves lower, so too should the federal funds rate. We still expect 2 cuts this year. The biggest risks are a re-acceleration in wage growth or some sort of government policy that reignites inflation. David joins us now for more. David, good morning.
Morning. How are you?
How excited can we get about the last 24 hours?
So I think it was more of a market breathing a sigh of relief as opposed to new information. I mean, what we're seeing is that we're making progress on inflation, but it's the services component that's particularly sticky. And when you break that down even further, where the heat is really coming through is in shelter and then transportation services. It feels like the auto insurance issue is in the process of running its course. Shelter should continue to soften. Where that leaves us is the biggest risk being that if wage growth begins to reaccelerate, that's going to show up in things like food away from home, that's going to show up in services more broadly, and that's really the risk to the Fed adopting a significantly more hawkish tone than they have up until this point.
Yesterday, both stocks and bonds rallied. Do you want to chase either?
So the positive correlation thing is tricky, and we spend a lot of time talking about that because in a perfect world, we'd end the year with stocks higher and rates lower. You know, how much lower can we really go on rates given where the Fed is and given where inflation is? I think that's the big question. You know, we're definitely leaning more into the risk side of the trade as opposed to the duration side of the trade. But I will say with the curve now, you know, positively sloping, you're getting a little bit of carry for being long. Duration doesn't look quite as problematic from a portfolio construction standpoint as it had been when the curve was inverted and you were basically having to pay to be longer out on the curve.
Can I ask, in the curve and the shape that it's doing and getting more steep, there's been a lot of commentary that it's people concerned about fiscal deficits, that it's concerned about the economy. But to some degree, David, this is just normal. This is how things were before the GFC. Is there any element of what we're seeing actually a good thing and a return to some sort of normalization in the yield curve?
So, I mean, fundamentally, having a positively sloped yield curve and having a base rate that isn't zero, I think, is very healthy for economies broadly. What I think is particularly interesting about where we are today and the move that we've seen in long rates over the past couple of weeks is really that it is being driven by those concerns around fiscal policy. If you look at the relationship between the 10-year yield and the economic policy uncertainty index, if you look at what's been going on with the term premium, right, all of these are moving higher together. And what that says to me is that the bond market is concerned about something more than the expected path of Fed policy. If we get one cut this year, 465, 475 on the 10-year is pretty much fair value. We would need to see the Fed engage with hikes to get to that 5% number, or we would need to see something on the fiscal front that just causes that concern amongst bond investors.
So some of that is the uncertainty premium. As you watch things like Scott Bessent's nomination hearing, as we go through the inauguration and you get different executive actions put in place, what is actually tradable and what just leads to more uncertainty?
So I think it's a question of signal and noise, and I think that the order of operations is going to matter quite a bit here. I mean, my sneaking suspicion is that when President Trump comes into office next week, the first thing he's going to do is unwind a lot of the things that the Biden administration had put into place. So that's step one. Step two is he moves on and begins to pursue his own agenda. We do think he's going to lead with immigration and tariffs, so we may get some of the more punitive stuff first. But on immigration, I think it's going to be a little bit more thoughtful than people are currently expecting. And on trade, I think that this is the beginning of a great negotiation. The news that's come out around tariffs kind of ebbs and flows, and somebody says one thing and then it gets walked back. I think that tells us a lot about what we should expect in terms of the evolution of trade policy going forward.
So it's used as bluster to get Xi Jinping basically to the table with this maximalist approach, but maybe he actually won't follow through on the maximalist approach. Is that your base case?
Exactly. I mean, if you look at where the United States gets the majority of its consumer electronics from, it's China. We're not going to put a 60% tariff on consumer electronics. Half the reason that Trump's going to be in the White House is because the Biden administration oversaw a period of elevated inflation. And so you have to kind of weigh those forces together and get a sense of, I think he's going to shoot it pretty straight down the middle, but there's going to be a lot of volatility along the way. And that's what we're trying to remind our clients.
That idea keeps coming up in a lot of conversations I have, that inflation is really important for this incoming administration to make sure they're getting down. And that's partially why they won this election. But there is potential that some of what Trump is talking about is inflationary. And you still have 2 cuts priced in for 2025 in the team. How do you weigh both of those?
So I think, first of all, it's important not to put the cart before the horse. And, it was just, 4 or 5 months ago when we were triggering the SOM rule and the economy's going into recession.
A year ago, we had 6. So,
markets are still somewhat twitchy. I think the reality is that the broader trend in inflation is lower, and the Fed clearly views the current level of the Fed funds rate as being restrictive. So they remain on a path of more easing. How quickly that easing materializes, to me, is the bigger question. People were talking about March and June and then done. I think we might see first half, second half done, but we're not going to cross that second cut out until we have information that inflation isn't coming down the way that the Fed would like to see. With respect to the interaction with the policies coming out of the White House, tariffs are a one-time level shift. And so we don't really view that, unless it becomes truly tit for tat, as being a source of inflation that the Fed is going to focus on. Immigration could be somewhat inflationary, but I think that takes time to play out. If you look historically, inflation does come in waves. It tends to be a first wave, a pause, and a second wave. To me, if we get that second wave of inflation, and I think it's still a big if, much more of a 2026 story than a 2025 story when you have those tax cuts coming through, when you have more progress on deregulation, and when you have some of these inflationary policies finally working their way through the system and beginning to show up in the data.
Absent a breakdown in the labour market, should the Fed's bias just be to wait? Why would they cut at all, given everything you've just said?
So I think that the reason that they should cut is because, again, if you look at the real Fed funds rate, it is somewhat punitive. Also, when you look at a broad mosaic of labor market data, the 250 payroll gain we got last week doesn't exactly line up with a lot of the other
So you're not
data
buying
points.
the 250?
I'm not buying the 250. I'm buying the fact that the quits rate has been stable and relatively low. And I think that tells you everything you need to know, because if you're not able to walk out the door of your building, go across the street and get paid 20% more to do the same job, that tells you a lot about the state of the labor market. So, look, the labor market's healthy. 4% unemployment, 4% wage growth. This is all really good stuff. But I do think on the fringes, you're seeing that softening. And that is what is causing the Fed a bit of concern in this environment.
If you had to take a bet, if you were thinking about how this labor market might break, a re-acceleration or a real deceleration, are you betting on the latter and not the former?
I do think that the risk is still to the upside. You know, this is a very healthy economy. Real income growth remains positive. We have the prospect, if we get this deregulation, if you get, more favorable tax treatment, you could see CapEx begin to tick higher. And that's one of the more cyclical parts of the economy. And so, the engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that that's probably a risk that we can't dismiss.
I find it really notable that the thing that continues to be consistent is that quits are lower. It's getting harder to find new work, and you're seeing wage growth stagnant. If you don't trust the headline data, should we just continue to look at that? Does that need to be our guiding star in this economy?
So that's why I was so surprised on Friday, and everybody was freaking out, 250,000 jobs. I'm like, guys, wage growth is coming down. I mean, isn't that what really matters when it comes to inflation? It's not the number of jobs you're creating, it's the amount of money that's going into people's pockets. And furthermore, the data from the Atlanta Fed yesterday that breaks down wage growth by income quartile showed that those lower income individuals are finally seeing wage growth begin to slow. And that's important because those are the individuals with a higher marginal propensity to consume. They spend every dollar that comes into their pocket. So that's really what can cause the delta when it comes to things like growth and inflation.
Peter Scheer of Academy Securities made this exact same point the other day, but he went on to say that his concern is that the Fed is paying attention to the headline data, that the Fed is reacting to data points that might be skewed. Do you share that concern?
I think that the Fed does a very good job of looking at a broad mosaic. I mean, they have a staff of economists that are spending time on all of this stuff. Yes, they're not going to fade the 250 number because there could be a signal, but it could also be noise. And so I think they'll continue to just look at what the data more broadly is telling them and try to square that with their own forecasts when coming up with the appropriate trajectory for monetary policy.
If the data is so noisy, should we just do what Mohamed El-Arian told me to do ages ago, which is listen to the CEOs? This morning, BP cutting 5% of the workforce. Yesterday, we had headlines from Microsoft, from Meta, from Southwest. Are these idiosyncratic or is there a trend?
I think for the time being, it's somewhat idiosyncratic. The calendar turns, beginning of the year, a little bit of cleaning out the closet, if you will. But I think we need to watch these developments quite closely. And again, coming back to the quits rate, part of what gives me comfort about the labor market is that the quits rate is low, but the layoff rate is also low. And if we begin to see that trend higher in a more material type of way, that's when I think you may see the Fed begin to express a bit more concern about the growth side of the equation and fade some of the inflationary pressure.
We won't discuss return to office policy, don't worry. David, it's good to see you. David Lebovitz there, JP Morgan. David, thank you. Good to see you, mate. Equity futures on the S&P positive by 0.2%. A little bit later this morning, 7:30 Eastern Time. Numbers from Morgan Stanley. After that, 1 hour later, we'll get some more data for you. We will have jobless claims and retail sales. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden gave his farewell address to the nation from the Oval Office last night. The president used his speech to hail his accomplishments like negotiating a Gaza ceasefire deal and a sweeping infrastructure package. He also delivered a warning about the upcoming administration.
Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms.
Biden will attend Trump's inauguration on Monday. Meanwhile, Taiwan semiconductor shares are up in the pre-market more than 4% after reporting an upbeat outlook. The chipmaker's projected quarterly sales came in above expectations, and it says it plans to spend more on technology and capacity in its current quarter. This comes despite uncertainty between U.S. and China trade relations under the upcoming Trump administration, and Taiwan caught in the crosshairs. Meanwhile, shares of Richemont are soaring in Swiss trading after sales surprisingly jumped 10% over the holiday season. Analysts had expected gains of less than 1%. The sales largely coming from strong demand for expensive jewelry like Cartier in the Americas and Europe, offsetting weak watch sales. The news boosted shares of other key players like LVMH and Hermes. As optimism grows, the worst may be over for luxury. That's Bloomberg Brief. John?
Hey, Yahara, thank you. Big rally for the luxury players over in Europe, listed in Paris, France. Up next on the programme, Trump's picks facing a grilling on Capitol Hill.
I will fight every day to restore confidence and integrity to the Department of Justice.
We are once again called to create a free world out of the chaos. And this will not be easy.
That story up next, live from New York City this morning. Good morning. Equities right now positive by 0.2%. Numbers from Bank of America pretty good. That stock is rallying again this morning. More numbers in just a moment from Morgan Stanley. Those numbers drop at 7:30 Eastern Time. Under surveillance on Capitol Hill, Trump's picks facing a grilling.
I will fight every day to restore confidence and integrity to the Department of Justice and each of its components. The partisanship, the weaponization will be gone.
We are once again called to create a free world out of the chaos. And this will not be easy. And it will be impossible without a strong and a confident America that engages in the world, putting our core national interests once again above all else.
So here's the latest this morning. Attorney General nominee Pam Bondi and Secretary of State nominee Marco Rubio among Trump's picks meeting lawmakers on Capitol Hill. Today, Treasury Secretary nominee Scott Bessent will face the Senate Finance Committee and is expected to talk about a, quote, economic golden age under incoming President Donald Trump. Joining us now to discuss, Jessica Taylor of the Cook Political Report. Jessica, welcome to the programme. How easy will Scott Bessent have things later this morning?
I think he's going to face tough questions from Democrats, certainly, especially about tariffs and the Trump tax cuts and things. But I think they'll probably center on some of his background and things. But he is not overall a controversial pick. He's going to be easily confirmed, probably with some Democratic support. But this is not one of the, high-profile, controversial nominees that Trump has made.
It's high profile for our viewers, though, to watch and try to understand potentially some color about the policies we can see from Trump 2.0. When it comes to potential fiery exchanges in this hearing, which senators exactly are you going to be looking for?
I mean, I think Elizabeth Warren is top of the list, just given her, opposition to sort of Trump's worldview on things. So I think I'm looking to her particularly. And, but I think Republicans are going to have his back, certainly. And remember, he's someone that's also donated to Democrats in the past. He's certainly come around to Trump's economic worldview, but he's not someone that's been in Trump's inner circle either as well.
True. Neil Dutta has reminded our audiences before this is an individual who has had the temperament to work for both George Soros and Donald Trump. Okay, so let's broaden it out to potentially some of these other cabinet picks. Who do you think is going to be most difficult to get Senate confirmed?
I mean, I think at this point it might be Tulsi Gabbard, but even she looks like she's probably on the path. I mean, at this point, I think probably all of them have to be favored in that regard. We had Pete Hegseth's nomination they had the very contentious confirmation hearings, but still not as contentious as I expected it to be on Tuesday. And, a key Joni Ernst came out saying that she would vote for him, a senator that we were watching, given her past history in the military and especially past history of sexual assault. And then notably last night, John Curtis, the new senator from Utah, also said that he would vote for Hegseth. So with those key Republicans coming out for him, it's hard for me to see how he gets 4 Republicans that would oppose him. Even Gabbard, now that she has switched her position on, some of the surveillance, specifically Section 702 and different things you have, particularly John Langford in Ohio that came out over the weekend saying he would back her. It might just be, remember how rare it is. We haven't seen a nominee since John Tower in the George H.W. Bush administration that is voted down on the Senate floor. Typically, these nominees, the writing is on the wall and that they withdraw in the same way that Matt Gaetz did. And it's not uncommon to have a president that withdraws. Typically, everyone has someone that they end up withdrawing for various reasons. So it might have been that the Gaetz pick was that one. And I think when you put forward someone like Gaetz, someone like Pam Bondi, that in another world might have been more controversial. She comes across as much more palatable to Democrats because I think they're thinking, well, we could have had Matt Gaetz in that instance.
When it comes to the actual votes, when they take place, which senators do you think would be the ones that potentially could say, you know what, I'm just not going to vote for this individual? Republicans.
Yeah, I mean, the two key moderates that I'm watching are Susan Collins of Maine and Lisa Murkowski of Alaska. Collins is up for re-election. She is the only Republican running in a state in 2026 that voted for Harris, and then also voted for Biden in 2020 as well, and for Clinton in 2016. But she won re-election in 2020. Remember, even as Biden carried her state, and Republicans, Democrats are struggling to kind of get a top tier. It's very early, but a lot of their key Democrats are probably going to run for governor and maybe not for Senate. So she's less susceptible to a primary challenge, which is sort of the key motivating factor. I think, against someone like Ernst, that if she might have voted against them, she's also up in 2026. Already had Republicans, including some very conservative leaders in Iowa, that were talking about running against her in a primary. Lisa Murkowski is also a little bit unencumbered because her state decided to keep ranked choice voting. They have an all-party primary system where the top four candidates advance, and then then they're chosen based on ranked choice voting. So she's also not susceptible to a primary challenge. I'm also looking at Mitch McConnell. He's not the Republican leader anymore. He does not share Trump's worldview, particularly on foreign policy and different things. And it's widely expected that he is not going to run for re-election in 2026. So he also does not sort of feel this pull. And especially as leader, he doesn't have to sort of have those relationships in the same way. John Curtis, I mentioned, of Utah, he's another one I've been watching, and it was, again, very key when he came out for Hegseth. What does he do on Gabbard? Remember, we still have Kash Patel coming up for the FBI. Todd Young is another person from Indiana. He did not endorse Trump. He's been sort of more MAGA skeptic to Trump world. And then when it comes to, for instance, RFK at HHS, the chair of the Help Committee, Bill Cassidy of Louisiana, he actually voted to convict Trump in his second impeachment hearing. He's already getting primary challengers in Louisiana. Now, when he was last reelected, Louisiana had an all-party primary, so he was a little bit more inoculated in the same way that Lisa Murkowski was. But they recently changed their laws, so he will have to run in a traditional primary that he's never had to before. So he faces a real primary threat as well in 2026.
Jessica, when it comes today and what we're likely to hear from Scott Bessent, we know a lot of the questions will revolve around tariffs. From what we hear from him, how influential do you think Scott Bessent's push will be to Donald Trump when it comes to setting tariff policy, or will it all be about what Trump wants?
I think that Trump has surrounded himself with loyalists, and Bessent has become that, I think, but I think he also brings sort of a broader worldview in sort of the financial world than Donald Trump has, and sort of these nuts and bolts of the financial world. So, I do think he will be influential in that regard, but I think Trump also has someone, he's picked him because he has this experience, and I think that is broadly appealing and reassuring to a lot of senators, but he is someone that has come around to Trump's view, particularly on tariffs as well.
Hey, Jessica, appreciate your time. It's good to catch up and hear from you. Thank you. Jessica Taylor there of the Cook Political Report, I think can make the argument the most influential person in all of this, the Treasury market. Mr. Bond Market, Mrs. Bond Market is going to have some things to say potentially. They want to run this economy hot. And they will, so long as fixed income and this Treasury market allows them to.
This is something Scott Bessent knows extremely well, too. Last January, in a letter to investors in his hedge fund, he basically wrote that the only thing that can stop Donald Trump and the exceptionalism of an economy under Donald Trump is high long-term yields. He is acutely aware of that, and that also might color what he says today.
Definitely. And this is something that it's not just Scott Bessent that's watching. I'm still taken aback that J.D. Vance, soon to be vice president,
quoting 10-year bond yields
on Fox News Sunday morning program. It's pretty exceptional, and you have to think this is where they're focused on.
You know what Brahma would like? To take bond auctions mainstream. She'd like to see that mainstream. We'll see if we can make that happen. Equity futures right now in the S&P positive by about 0.1%. Up next, we get some results from Morgan Stanley to round out the numbers on Wall Street. So far, so good for the earnings on Wall Street. It kicked off with JP Morgan yesterday. JP Morgan numbers, really good. The outlook, even better for Goldman Sachs. Fantastic trading figures. For Bank of America, the investment bank, looking better than good. For Morgan Stanley, we'll get those numbers any second, and we'll see if we can get a clean sweep on Wall Street. Equity futures on the S&P 500 shaping up as follows. Futures positive by a little more than 0.1% on the S&P. On the Nasdaq 100, we're up by a third. On the S&P, a 3-day winning streak. And yesterday, on the S&P 500, on the Nasdaq and the Russell, the biggest one-day gain going back to the post-election bump on November 6th. That's the equity story. Here's the bond market picture. 2-year, 10-year, 30-year. On a 10-year Treasury yield, yields are up by 2 basis points. The yield right now, 467.77. A little bit later this morning, we get some data. Jobless claims and retail sales. Then after that, a hearing on Capitol Hill with the Treasury Secretary-designate Scott Bessent and some big questions, Danny, about what he's going to do with this Treasury market.
It's going to be very crucial to the shape of this curve because he has been really critical, along with the likes of Nouriel Roubini and others, that Janet Yellen didn't term out the debt, that too much of the debt has been concentrated in T-bills. So him and his past remarks shows a willingness to do that, to issue more longer-term debt. But at the same time, Scott Bessent is very aware that longer yields, higher yields are a bad thing. So how does he strike that balance? Is he able to issue longer-term debt, but also keep yields at a ceiling?
And also, how does he handle the debt ceiling? This is going to be a massive fight on Capitol Hill, and it should have been, for many Republican voices, dealt with in 2024. Clear the decks before 2025. It wasn't. This is going to be a fight, and I guarantee they're going to ask him, do you think we should just get rid of the debt ceiling? What I would say, though, on issuance of debt, because Scott Bessent has taken a lot of aim on Treasury Secretary Janet Yellen about this, it is easy to criticize from the sidelines. It's going to be hard when you're in the chair.
Things could change a lot in the next week or so. I think a lot of people taking comfort, for good reason, from the bank earnings we've seen so far, from the inflation figures we saw yesterday, that softer CPI print, also softer PPI as well. But that can all change on Monday morning when we get the inauguration. And then later on in the evening, you start to see them gear up to release a load of executive orders and the focus shifts quickly, maybe to trade, perhaps to something else. Who knows? Let's turn to this in foreign exchange. It will also have implications for other central banks. The BOJ and our reporting suggesting the BOJ is gearing up for a rate hike here. Dollar yen's down to 156.13. And really the only outstanding question for the Bank of Japan, it's not even the data coming out of Japan. It's what happens next with the policy of the incoming administration.
You can't help but laugh because it's almost a ridiculous place that they find themselves in, that just days before their meeting, they won't know what they're doing until they get some executive orders coming down. Look, for all of the criticism that the Fed is too reactive, you have a Bank of Japan that's not even reactive to their own data, but is reactive to American data and U.S. politics. It's a necessity. And you could argue that in America, it's a necessity, too, that the Fed needs to understand what fiscal policy is going to look like before they set their agenda for the year.
Policy and the political economy will be the driving force for markets in 2025 and for, clearly, central bank leaders. What does everyone always say? The Fed is the global central bank for the world. The Fed is the central bank. Well, then what does that make Donald Trump?
The president of the world right now and dictating a lot of policies in a big way. In the next few minutes, any moment now, we'll get some numbers from Morgan Stanley. When they break, we'll bring them to you. I want to start with a few other stories, though. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu accusing Hamas of walking back conditions of a ceasefire. His office saying new demands are an effort to, quote, extort last-minute concessions. The Israeli cabinet won't gather to approve the ceasefire until Hamas accepts all terms.
I would say a lot of this potentially is internal politics. And I also think, given the fact that these are a state of Israel with Hamas, which is designated a terrorist organization at war, you can imagine there are going to be a lot of stop and go, starts and stops when it comes to this. Right now, though, this deal is holding, and this means 33 hostages, including Americans, will be released starting this weekend. And I've been told 24 of those hostages are alive, Jonathan.
I mentioned those numbers coming from Morgan Stanley. They drop right now. Let's cross over to Manus Cranny for more. Manus, you're poring over these figures. What do you see?
Beats are a beautiful thing, Jonathan. Wealth management, their core in this number is 7.5 billion. The market was looking for 7.3 billion. Fourth quarter net interest income, 2.55, 2 nickel. The estimate out there was for 2 billion. Again, adding to the sweep of beats on net interest income and guidance. So net interest income, 2.55 billion, way above the estimates. Also keeping a check on expenses. Compensation expenses, to be precise, 5.95 billion, below the 6.64 billion that was estimated. Jane Fraser had that battle on her hands at Citi in terms of reorganizing it. But this is a beat on wealth management, a beat on expenses, a beat on net interest income. Provision for credit losses, slips to $3 million. This is an economy that is strong, that is on fire. I'm just trying to check for the advisory side of the business as well. Haven't quite got those yet. But Jonathan, on first sweep, this is a very comfortable beat on a trifecta of issues for Morgan Stanley.
Manus Cranny, stay close and I'll come back to you. Bear in mind that this stock rallied yesterday by almost 5%. The read-through coming from Goldman Sachs' numbers, which were pretty tremendous. Morgan Stanley's up by 1.4% in the pre-market. Shnali, did we get our clean sweep on Wall Street?
We got more than a clean sweep. I mean, if you look at equities trading at Morgan Stanley, I had to look 3 times because it's at $3.3 billion. The estimate was for $2.6 billion. So they're coming in almost $1 billion more than expected. And not to mention, they're coming in $1.3 billion more than JP Morgan. So they are just under Goldman Sachs. This is that heated competition under the surface I was talking about. This was Ted Pick's home court. So they are showing that on the core Wall Street businesses, they are just slamming through the roof. And in addition to that, the margins for wealth management are also very strong. They're coming in just about as expected, even a little bit higher, while keeping compensation expenses under control, making more money and delivering more profit back to shareholders.
Can we go back to one of the numbers that Manus mentioned? That, again, is another theme with these banks. Provisions for credit losses were $3 million. The estimate was just under $74 million. That is so much less set aside.
Yeah.
What does that speak to, not just credit quality, but the risk that these banks are taking on at this moment?
Really important, I think, here is to recognize that Morgan Stanley and even Bank of America at this point, they're lending to wealthier consumers. The credit quality is not going to be as tough as we see later in the earnings season. One that I'm looking out for, Ally Financial. Even Carvana, right? I mean, you have to look at what's happening in autos. You have to look at what's happening with FICO scores that are not 800.
That feels like a lifetime ago when Ally Financial came out with a warning.
Right.
How long ago was that?
Last quarter. I mean, it was during the end of last year.
It feels like years ago since that happened. It feels like this market and this sector has moved on pretty quickly since then.
However, there's a bifurcation, and that's why we have to keep watching what happens through the next couple of weeks. Do the smaller banks and smaller lenders come out as strong as these mega banks? Yes, fine. They're making a lot of money at the higher end. They're making a ton of money on Wall Street, businesses, trading, investment banking. Does that look the same? Is loan demand going to be as strong at some of these other firms when people are already maxed out on their credit cards?
So maybe you can extrapolate it to some of the regional banks, especially when you don't have some of these trading wealth management businesses. For Morgan Stanley and wealth management, we go back to the Goldman thing we talked about yesterday, the fact that they're pouring into private credit. As they manage these businesses, what business model makes sense for Morgan Stanley? How are they achieving these sorts of numbers when all these banks are flocking to this area?
You know, there was this great story in the Financial Times at the end of last year. People might have been on vacation and missed it. This whole thing about how Ken Moelis... Oh, I actually did not mean to shade you on that one, but you were on vacation,
for taking vacation?
Yeah, she looked at you when she said that.
Am I on vacation now? Is this a permanent vacation? Continue, please.
Well, what people have learned is that this capital markets banker, the conception of that is really the future of Wall Street. And you could see it all the way at the top of these firms. Ted Pick, capital markets. David Solomon, capital markets. Goldman Sachs, new capital market solutions group. And it is that recognition that the way people raise money are different now, and that these private credit players are a huge part of that story. By the way, some of these companies might just stay private for longer. Think OpenAI, think SpaceX. Morgan Stanley, what I know is that they're working really hard to make those private markets more liquid.
Can I just clarify? I don't take that much vacation. I think you all just miss me when I'm gone. I think that's what it's really about. Of course, that's what it's about. The numbers from Morgan Stanley, then, if you are just joining us, wealth management revenue coming in at around 7.5 billion. The estimate was 7.3. Shnali talked about the equity tradings revenue, 3.33 billion. The estimate 2.63. An upside surprise on FIC trading as well. That came in at 1.93 billion. The estimate 1.68. That's for sales and trading revenue in the fourth quarter for FIC. Manus Cranny still with us. Manus, put it all together. The quarter on Wall Street and look ahead to the rest of the year. How much better could it be for 25?
Look, it very clearly differentiates. Yesterday was a story about FICC. Today it's Morgan Stanley in terms of the equities business. But they've got that natural book flow from the wealth management business back into the equity side of the business. That's the paradigm that every CEO out there wants. They want to marry up that wealth management, the investment banking, get the synergies, and then they've got much better flow. I think what you've got to consider here, Jonathan, is a 2025, look, it's a mug's game to sort of like put a number on what investment bankers are going to do this year, or what institutional banking is going to do, or what FICC is going to do. But what you can be sure of is that the capital rules are changing. Basel endgame is ending. What do you do with the excess capital? Where does that go? Is it a bully year for buybacks, or is it a deployment of capital? In a deregulatory environment and with a renewed push for IPOs, debt and equity capital markets, perhaps you can establish a floor under which you see 2025. Rather than a cap and perhaps a ceiling for 2025, it's about what is the floor. And the floor looks pretty solid with an underpinning on it. Right now, Morgan Stanley leads this pack in terms of the equity side of the market. The advisory side of these banks is going to build up. We know that there's a pipeline there. There's a lot of anticipation in terms of the ability to do deals and get deals done in the era of the next Trump administration. That's my take. Ted Pick, by the way, he says institutional securities saw strength across markets.
Interesting. Manus, thank you. Morgan Stanley up by 1.5%. We'll catch up with Ted in Davos at the World Economic Forum in about a week from now. Shonali, I want to give you the final word on the quarter that we've seen. Pretty decent, better than good.
Pretty decent, better than good. But I still leave the last word to David Solomon here, who spent all this time talking about how they're suing the Federal Reserve. The fight is not over here. Them and every other large bank, they are still looking for more transparency, and this is the year they're going to get it.
Great work over the last 24 hours. Appreciate it. Thank you. Making our job easy. Shonali Basak there, breaking down the earnings on Wall Street. I want to check out euro-dollar just before we move on. Check this out. Just breaking down a touch. A weaker euro. Off the back of the accounts released from the ECB, Danny, listen to this. Some members wanted a deeper debate about a 50 basis point cut.
Schnabel also talking about the accounts that the euro drop versus the dollar had been pronounced. It's almost a good thing for them, though, to have a weaker euro. They need that drop. And, John, let me just say, I'm glad you said accounts. One of the first mistakes I made was calling it minutes.
Oh, no, they're not minutes. No, they're accounts.
I felt the heat.
They get very unhappy about that. I'm not sure why. Euro-dollar's negative 0.2%, 102.69. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with the latest out of Southern California, where wind speeds have begun to weaken. That bringing some much-needed relief as firefighters try to contain the fires. However, the Santa Ana winds could return next week, which could bring more dangerous conditions. Investigators are turning their attention to a ridge line that overlooks the Pacific Palisades as a potential source to the fires. The area includes a popular hiking trail that was the scene of a small fire days before the blazes spread. Meanwhile, the U.S. Department of Transportation is suing Southwest Airlines for what it says are unlawful chronic flight delays. The agency alleges Southwest violated rules that require airlines to set and meet realistic flight schedules and said it would seek maximum civil penalties. In a statement, the airline said that it's disappointed that the DOT chose to file a lawsuit over what it says are 2 flights that occurred more than 2 years ago. Southwest also saying it's open to discussions about a reasonable settlement. And a group of investors led by LeBron James' business partner Maverick Carter is aiming to raise $5 billion for a new international basketball league. Bloomberg has learned the league would comprise 6 men's and 6 women's teams with games played in 8 cities around the world, modeled after Formula One's global rotation. The league is aiming to ultimately rival the NBA. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes. Up next on the programme, the strength of the US economy.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, on a very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now.
That conversation up next, live from New York. You're watching Bloomberg TV. Equity futures on the S&P positive by 0.1%. It's a clean sweep on Wall Street. Another set of decent numbers from another big bank, this time Morgan Stanley. Elsewhere in the bond market, yields are higher by 2 or 3 basis points. The 10-year 467.97. And the surveillance this morning, the strength of the US economy.
Overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now. It's got a lot coming up on the plate here, but overall, feel pretty good. I think the most important is the labour market.
So here's the latest this morning. US core CPI numbers coming in below expectations in the last 24 hours, boosting bets the Fed will cut sooner than previously anticipated. Another round of claims and retail sales data drops at 8:30 Eastern Time. Francis Donald of RBC disagreeing, writing, RBC Economics is no longer calling for any more rate cuts in 25. And the reason is simple. In our base case, the data simply won't give the Fed enough justification for further easing. Francis joins us now for more. Francis, good morning.
Good morning.
Did CPI yesterday change the story at all for you and the team?
No. Inflation is going to move downwards, but it's not going to get below the Fed's target. And more problematically, what is the balance of risks in the later part of this year? Everything I've heard about in the last 24 hours, the CPI was marginally below consensus. It's a game changer. First of all, the data was not a massive game changer in and of itself. But here's the issue, John. If we were just looking at a normal economic cycle, that would be one thing. We'd say, the economy's behaving like it's mid-cycle. This is the trend in jobs and inflation. But we know that there are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming. So where we are in December or January or February is far less important to the Fed call or the longer term market call than anything we find out next week when President Trump takes office and we start to get more of a sense of the sequence of his policy, the size and the scope of the policies ahead.
We've said it repeatedly on the show with guests, with yourself. The most important data point this month, perhaps this year, is Monday. It's inauguration. When you think about sources of inflation, and we had this conversation yesterday on the show, labour, energy, goods, services, where we're set up right now, where do you think we are most inflation prone when you start to think about policy changes?
So the inflation story is actually fairly simple. Goods are no longer going to be deflating. We know that housing is short on supply, so that OER number is going to keep a floor underneath it. And we got a heck of a ton of fiscal spending and the lagged effects of prior fiscal spending that's going to keep services alive. The labor market just doesn't have enough people. It'll have even fewer people moving forward. So that's the state of play where we are now. Now, the challenge is some of the policies that we know could be coming forward actually are disinflationary. Things like deregulation or any policies that help you increase productivity. But things like tariffs and immigration reform, those policies actually will increase inflation, and the magnitude depends on things like how does the US dollar move and other factors surrounding it. So the sequencing of effect, we've talked about this before, the sequencing, do we get the disinflationary ones first or the inflationary ones next? That's going to be really important for 2025, but looming over this more normal cycle that we're entering for the Fed is the threat of these disruptors that are coming through, and on balance, we see them as being more problematic for upsides to inflation than downsides.
Well, we know some number of Fed officials take that into account. How willing do you think the Fed is going to be not reactionary, but be preemptive when we understand some of the policies coming from Donald Trump?
Well, historically, they've told us we don't do that. We wait for the actualized policy to come through. And Chair Powell has been very clear. We actually want to see realized data and just how tariffs filter through into the economy. We're still learning. We got a little bit of experience. Economists know a lot about washing machines from 2018. We know about steel and aluminum tariffs. And we know that some of the currency can actually provide an offset, and how retaliatory other countries are also matters as well. So there are too many factors when it comes to modeling how a tariff impacts inflation for the Fed to respond proactively. But we've already heard them. We've already heard them through their balance of risks in the SEP, through some of them already incorporating that they know the risk of a tariff is not that it creates deflation, but that it creates inflation. Meanwhile, the labor market, it's looking kind of tight, even though there are some particularities, like layoffs are very low, but hiring is also very low. There's some really interesting things happening there. And this is a Fed that's going to be very aware, the market needs to get up on this, that this is going to be a supply-constrained labor market, so you're not going to have a significant increase in the unemployment rate, even though there may be some interesting factors under the surface there.
Personnel is policy, and today we're going to hear from a key personnel from the Trump administration, incoming Trump administration, that's Scott Bessent. What do you want to learn from him as an economist?
Oh, I want to understand the magnitude around some of these themes. So are we talking about things like 25% across the board tariffs, or are we talking about selected industries? And this is really important if you're trying to model these types of developments, because we're trying to figure out what are the primary industries that are hit and then what are the secondary knockoffs. We're probably not going to get that detailed policy. And this is the really core component to the uncertainty tax that will weigh on the U.S. in the next few months. One thing that I do expect is a combination of uncertainty, really slowing a lot of decisions, but then also some inventory hoarding. We saw that before. When you expect the price of something to go up, or you're an industry that suspects maybe I'm at risk here, could actually see inventories rise. So there are so many underlying factors. And what's so critical is these are not typical cyclical developments. So your typical cyclical economic model is not helping you here. You're making an excessive amount of assumptions that are coming through. We have to do some element of that. And that's why a lot of these base case forecasts that went out in the 2025 outlooks, including ours, appropriate modal forecasts, but to stay wedded to them right now, I think is too dangerous.
Just to put a bow on this, because the inflation, the stickiness that we have seen, a lot of it has been because of demand, that the consumer is still spending, the labor market is still robust. Does that shift, is what you're describing a supply shock? Is that the form of inflation that will take? And what does that mean for the Fed's ability to fight it and our ability to cope with it?
A beautiful question. And this is the most important macro theme for me for 2025. You talked about a bow. Let's put 10 bows on this. The U.S. economy is moving from a demand-led economy, the one that we all learned about in our economic textbooks, the one that created a Federal Reserve that said inflation is too hot. Let's slow the economy with higher interest rates, to one that is much more similar to a lot of the things we experienced during COVID. A labor market that doesn't have enough people, enough of the skills qualifications to fill health, enough of the immigration to fuel the retail, leisure, and accommodation area. This is going to be important to labor. And then on industry and manufacturing, it's not going to be about can we get, or do we want to have those intermediary goods? It's going to be, can we actually access them? So some of the lessons from COVID with different magnitudes are going to be very relevant here. And what's really critical for us is, how does the Federal Reserve respond, not just in the next 3 months or 6 months, but in the coming years, to an economy that is more supply-led and, dare I say, less interest rate sensitive. A little bit of an existential crisis for central banks, I think. We'll see as we go along. Another area of uncertainty, not just what will the data do, but how will the Fed respond to it. Lots of clouds and fog happening right now.
What do you think of how they've managed the message over the previous two meetings around the incoming administration?
Well, the challenge is, when I'm looking at a SEP, or I'm trying to understand the Fed's decision-making function, what Chair Powell explained to us is that they're all taking different approaches within the Federal Reserve. So we don't really have a lot of clarity there. One of the challenges for the Federal Reserve is they've been very clear we are data dependent. We want to see what the data does month to month. So then you get these huge outsized moves around things like CPI because of a decimal point off on the month over month. And then guess what we get? Revisions. We find out that there are seasonality distortions. Now we're going to go into January and we have a massive weather event, a horrible tragedy in California that's going to disrupt all my January data. So there is a little bit of danger with the data dependence comment in an era where we know seasonality, revisions, low response rates, and a myriad of other problems create less clarity around the month to month.
And there's a real sense that they're hypersensitive to the incoming information. And to Francis's point, Danny, that's why we're seeing these big moves in financial markets day to day, data point to data point.
And it's a criticism that the likes of Mohamed El-Erian has levied against the Fed, that the reason you're seeing this instability and volatility in financial markets is because what the Fed is doing. But it goes back to Francis's point. How do you have a longer term outlook when you just don't know what the consequences of tariffs will be?
We're going to have a lot of questions for this guy right here, the former Fed Vice Chair Richard Clarida, joining us very, very shortly, together with Collin Martin of Charles Schwab, Samana of Wells Fargo, Tom Fitzgerald of TD Cowen. A special thank you to Francis Donald of RBC. Equity futures on the S&P just about positive. The third hour of Bloomberg Surveillance up next.
The economy doesn't feel that strong, yet the Fed seems to be responding to that.
Everywhere I look, I see more inflation, not less inflation.
We're pricing in a stronger U.S. economy for longer.
Economic paralysis isn't really our outlook. We think we're going in with significant momentum.
The economy's been resilient, and it demonstrates that it might be able to continue to grow right through the end of the decade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Equity futures on the S&P just about unchanged. We're holding on to some gains from yesterday, the biggest one-day gain going back to early November 6th, the day after the election result that went Donald Trump's way. We're looking ahead to Donald Trump's inauguration on Monday. Equity futures elsewhere in the Nasdaq positive by 0.16%. For the financials, it's a clean sweep on Wall Street. Every single bank we've reported on has delivered an upside surprise. Morgan Stanley, the latest. That stock is up. Janney up by 1.26%.
It probably would have been up more if not for yesterday when all the banks had this huge rally, when we understood the scope of these numbers. Because, John, it is coming from everywhere. It is their trading figures blowing it out of the water thanks to the volatility in the fourth quarter. It is investment banking with the animal spirits of deal activity about to be unleashed. It's buybacks and shareholder returns thanks to maybe a more friendly regulatory environment. And it is their normal Main Street businesses, too, that the credit quality is getting better. It's hard to find an area that doesn't look positive.
Stock is up at a pre-market. To Danny's point, it was up almost 5% in yesterday's session. The next stop for this market is the economic data. A lot of those gains yesterday weren't just built on the bank earnings, it was built on a downside surprise on CPI. So look ahead, we've got retail sales and jobless claims, and then at 10:30, an important one. It's a hearing on Capitol Hill with Scott Bessent.
And this is what I think a lot of individuals are waiting to hear, to try to understand whether it's sequencing, whether it's policy priorities, or actually what is going to be the policy. Everyone comes on this program and they say the market is pricing in all the good stuff from Trump. But what about what the market views as the bad things? These are tariffs. Are we going to get any sort of clarity today from Scott Bessent? You know he's going to be asked about it, whether or not Donald Trump is going to come in and go for the blanket tariffs he promised on the campaign trail, or is he going to take a more gradual approach that Scott Bessent on this program, and I think August, was talking about.
Back in August, yeah, earlier in the summer. Another aspect of this conversation later, the Treasury market. What are they going to do with this debt? How are they going to term out the debt, even if they want to? A lot of it is short-term debt, particularly under Treasury Secretary Janet Yellen. Yields are rising this morning by 3 basis points. Already this morning, a lot of investors focused on that aspect of things.
Because if you're terming out the debt, the implication is that longer-term yields are going to be going higher. So now is the time that you want to do that. Scott Bessent, Nouriel Roubini, a lot of people had criticized Janet Yellen for concentrating in the T-bill part of the market. Whether that's right or wrong, it has happened. And it means that a lot of debt is coming due in a short maturity. Scott Bessent said he wants to term it out, but he also said that he wants to not have longer-term yields go up too much. I'm not really sure how you can do both because it's a supply issue. More debt on the longer end, yields go higher.
He's done a lot of daggers at Secretary Yellen, saying they're trying to juice the economy ahead of the election by holding down this longer-term debt issuance. A question he will probably be asked, will you be, quote, regular and predictable in your approach when it comes to debt issuance?
Debt issuance, not something else. Treasury yields lower aggressively yesterday. Too early for that. Yields up this morning by a couple of basis points. Coming up on the programme in the next 60 minutes, Samana of Wells Fargo with stocks looking to add to recent gains. Tom Fitzgerald of TD Cowen as Southwest faces a federal lawsuit over flight delays, and the former Fed Vice Chair Richard Clarida on the latest economic data. We begin this hour with stocks higher, notching their best close since the post-election day rally. Samana of Wells Fargo saying, look no further than better than expected CPI to see just how sensitive stocks and bonds are to incoming inflation data. The Fed has flexibility to cut interest rates further, but we think inflation's rebound will limit the interest rate cuts to just one in 2025. Samir joins us now for more. Samir, welcome. We caught up with Frances Donald of RBC. Asked her if inflation data yesterday changed the story for her at all. She expects no cuts in 25. She said it does not. Samir, how much did that little downside surprise on CPI change the story for you?
Not very much. I mean, look, we came into this year with the thinking that inflation would probably hang at a level higher than what most market participants expected. We have one more rate cut kind of penciled into this year, but again, the downside risk is that we don't get any this year. But I guess what we've been telling clients is, if it's for the right reasons, right? If it's because it's an economy that's on otherwise solid footing, if it's because, things are really good from a policy standpoint, then it's not as much of an issue if the Fed doesn't cut further.
So, Samir, what would you chase, the equity move or the bond market move in yesterday's session? Would you chase either?
I think we're on the equity side right now. Our year-end target is 6,600. If you kind of run the back of the envelope math, it's kind of in that, low to mid-teens once you throw in kind of the dividend yield. On the fixed income side, we don't see rates coming down a whole lot. Our year-end target is 4.5 to 5, so you're kind of in the middle of that range now. And again, if it's for the right reasons, we think the economy and the markets can handle those higher interest rates.
How much of what we're seeing in the move higher in yield, Samir, is just because of this volatility, that if the bond market has this type of volatility, that you can get CPI that comes in unrounded 0.002% away from being unchanged with expectations, that it moves this much, how much do you just need to demand a higher premium in this bond market for that very fact?
Yeah, I mean, look, you can see it in the 10-year term premium, right? It's finally positive, and it's positive by a good bit. Now, I think it's also interesting to note that, it's still below its historic average, so you could have it go further. But I think it's bond investors waking up, for 30, 40 years, they kind of just got positive returns as yields continue to just grind lower, and they've got to kind of sharpen their pencils a little bit and consider that now that we're in a world where rates could remain elevated, and you might be in a range as opposed to, kind of an uptrend or a downtrend.
Samir, I've heard that before, this idea that the bond market had been boring. But the way that I usually hear that play out is that it means that the vigilantes are gone, that everybody's an indexer in this bond market now. All the excitement has disappeared. So the people who would usually pressure the government before aren't existent in that bond market anymore. What do you make of that argument?
Yeah, I mean, I would say maybe they were dormant. Maybe they got a little complacent. But I think now, I go back a little bit to, what you said about, banks firing on all cylinders, right? You've got the term premium moving. You've got the inflation premium going higher on kind of inflation expectations if you look at one-year swaps. You've got the real component moving up if you look at tips. So you've got almost all the things moving towards higher yields. And so I think, before it was maybe one or two of those different things. But now that you've got all three going, I think it's time to really think about, how to position fixed income properly in that scenario.
Samir, John keeps talking about the fact that maybe the most important data point to this market and to investors is going to be the inauguration of Donald Trump next week. Can you just walk us through some of your base case analysis of policies we can expect?
Yeah, I mean, I guess let me at least preface that with, we've always viewed policy as either an accelerant or a dampener. By itself, it rarely makes trends. So I guess maybe let me start with that. But I think it'd be fair to say that you're probably going to see something on the tariff side of things. I think it's probably fair to say you'll see something on the immigration side of things. Now some could argue that that's probably some of the more negative, policy pieces, again, because, taxes and some of those other things will take a little bit of time to kind of implement. That being said, even those policies, if they're announced on day one, it could be phased in. It could be much lower than markets anticipated. It could be something that companies are able to pass along to consumers and it doesn't cause any type of hiccup. So I guess what we're at least trying to do is wait for the policy announcements. We do take President-elect Trump seriously, but until we actually have the policies kind of in hand, it's hard to tell exactly what impact they'll have. But I will say, heading into it with a strong economy, with strong earnings growth, again, it could be a dampener. I don't think it'll be a derailer.
So you take him seriously, but do you take him literally? Say 60% on China?
Clearly that's the one area where both sides of the aisle agree on. But even with China, it does seem like he's looking for a deal. It doesn't seem like he really wants to, kind of end the trading relationship. So I guess it depends. If they start to phase something in with China, let's say, I think the ruble, last week was, or earlier this week was 2.5% to 5% every month. Maybe, again, that's how they choose to do it. And if the Chinese are okay with 60%, because they find some workaround, then, you could see that level of tariffs. Again, that's not our base case, but it's something that, could possibly happen.
Samir, he's not running again. He's got 4 years. Do you think parts of Wall Street, from the conversations you're having, are underestimating how quickly this administration is going to want to move?
I think so. And look, from that standpoint, and this goes back a little bit to almost all these policies and them being either kind of a dampener or an accelerant. I mean, look, right now, they're accentuating a lot of what we've seen over the past 3, 5, 10 years, right? You want to lean into the U.S. You want to lean into large caps. You want to fade emerging markets. You want to be more cyclical. You want to kind of fade defensive. So I think the really nice part for investors is they're kind of amplifying what's already kind of been the positioning or the right way to position. But yeah, I think you're right. I think that is, where the risk is that the markets are maybe underappreciating how quickly they're going to move with the fact that they've had, almost 4 years to plan for this.
If the markets are underappreciating it, where is it showing up, Samir? What looks mispriced that's not fully appreciating the risk of acting quickly?
Well, I think that's what's so fascinating is the market is almost acting exactly as it should, right? Emerging markets have been very weak. EM currencies have been very weak. If there is a place where maybe it's underappreciating a little bit, I think it's still going back to the rate side. If you really have strong growth and you have an upside skew to inflation, I think you could see an overshoot in interest rates on the long end.
Hey, Samir, appreciate your time. Samir Samana of Wells Fargo. Focused on the long end and a possible overshoot. We have seen 5% a couple of times over the last week. We're south of that level after yesterday's rally post-CPI. We're down about 490 to 490 from around 5% where we were trading. We're down a few basis points, up a few basis points on today's session, down aggressively in yesterday's. Connor Sen, one of my favourite columnists on Bloomberg Opinion, out with this morning. Watch the White House, not the Fed, for signs of if and when the next rate cut will come. Saying this, the inflation genie is moving to the White House. Price and wage trends point to the Fed hitting its target this year, but whether it gets there now depends on Trump. And Francis Donald of RBC basically on board with that view.
I think it's so important. Also, the question you asked to Samir, is the market underappreciating how fast Trump will move? I think there's this hubris among investors being like, we're so smart. Whatever Trump says, we can see through it. We understand that it's bluster. But is it really bluster? If you're negotiating with Europe, you're negotiating with China, you can't just get bluster. You have to be serious about it. So again, it seems like the point of this market saying, I don't know, we can see through it, but European and foreign leaders, they're not going to be able to see through it.
Tobin Marcus of Wolf Research just put out a note and talks about expectations you can expect these first few days. And he says on tariffs, not sure yet if this will be a day one, especially conflicting reports and the fact that nothing has been presented yet, according to our report, to President-elect Donald Trump. But he said it's still their expectation that for tariffs, it's big but slow.
Monday's meant to be a day off. I'm not sure Monday's going to be a day
Not for
off. No, I'm not sure Monday's going to be a day off for anyone on Wall Street.
I don't know about you two.
I think everyone's going to be tuned in to see what happens on day one and day two and beyond through the next 4 years. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. It was a strong fourth quarter for the biggest U.S. banks. Bank of America reporting better than expected fourth quarter results and offering an upbeat forecast for 2025. Morgan Stanley also beating expectations on strong equity and fixed income sales. Turning to politics, Donald Trump's nominee for Secretary of State Marco Rubio signaled that the president-elect is likely to put Cuba back on the state sponsor of terrorism list. Trump gave Cuba the designation before the end of his term in 2021, but just this week, Biden reversed it in a bid to secure the release of political prisoners. Rubio cited Cuba's friendliness toward Hamas and Hezbollah as reasons for the designation. And the biggest names in tech will be among the high-profile guests at Donald Trump's inauguration Monday. Tim Cook, Jeff Bezos, Mark Zuckerberg, and of course, Elon Musk are all expected at the ceremonies in Washington. Their attendance is seen as an effort to build relationships with the new administration, with Apple's Tim Cook particularly interested in avoiding new tariffs on iPhones and regulatory crackdowns on its App Store. That's your Bloomberg Brief. John?
Yahara, thank you. Everybody wants a carve-out, don't they? Everybody does. There's this really odd tension that's going to take place next week between the World Economic Forum and inauguration. And these CEOs are placing their bets. They know where they want to be. It's not the WEF. It's down in Washington, D.C.
It's in front of the Capitol and seeing Donald Trump get sworn in as the 47th president of the United States, especially when it comes to someone like, you have to imagine, Apple's Tim Cook, looking maybe for that leverage to get a carve-out. How important and how critical are tariffs going to be on his bottom line? Also, add to that list, the TikTok CEO, according to the New York Times, will also be in attendance.
I was doing some phone calls yesterday, preparing for next week with some guests that we're going to be talking to. Fantastic lineup. We'll reveal it all for you at the end of this week. We'll do that tomorrow morning. And they all said the same thing. They basically said it doesn't really matter what we've got to say right now because on Monday it's inauguration and we'll see what the president's got to say and ultimately we'll react to that.
I was trying to tell the WEF, you need to have the World Economic Forum, maybe D.C., maybe Palm Beach.
Mar-a-Lago.
Better use of their time.
Yeah, I think maybe things are going to move around. Maybe in the future, who knows? Up next on the programme, the Morning Calls Plus, Tom Fitzgerald of TD Cowen as the Department of Transportation slaps Southwest Airlines with a lawsuit. We'll get into the details next. Stocks just about holding on to yesterday's gains. Equity futures on the S&P 500 just about unchanged in 13 minutes' time. We'll get some data for you. US retail sales and jobless claims. Yields are rising going into that after falling aggressively in yesterday's session. Your 10-year 468 17. Let's get you some morning calls. First up, Barclays raising its price target on JP Morgan to 330, citing its Q4 earnings as exceeding expectations. That stock pulling back from yesterday's gains. We're down just 1%. Your second call from Bank of America upgrading UPS to buy, noting benefit in its dynamic pricing model and an end to the freight recession. Their stock is up by 1.5%. And finally, Citi downgrading Southwest Airlines to sell, saying its earnings quality and free cash flow is weaker than pre-pandemic. Their stock is negative by 2.1%. Let's stick with Southwest, the airline, under pressure after the Department of Transportation filed a lawsuit alleging chronic flight delays. Southwest pushing back, saying the department's claims are, quote, not credible. Tom Fitzgerald of TD Cowen keeping a hold rating on the stock. He joins us now for more. What's the excuse? How do you say, and welcome to the programme, it's not credible? Can't we all just see whether they're late or not?
Well, I think, these are two flights from 2022, which was an extremely challenging year for the industry. It was the real first reset post-pandemic, and you had a massive juniority headwind from all the senior talent that was lost in 2020 and 2021.
Not just Southwest, right?
Yep, industry-wide.
JetBlue have got their own problems too.
Oh, yeah.
What's going wrong? What is behind that?
It's a really challenging operating environment right now. I mean, JetBlue, they operate, New York and Florida are two of their biggest markets, and those are some of the most crowded airspaces, chronically delayed, like really congested places to operate in. So I think there's a confluence of factors going on.
What do you make of the timing of this lawsuit, though? The fact it's happening in the waning days of Biden's administration, and the fact that a Trump administration and DOJ will have to be the ones that take, DOT rather, have to take this forward.
Yeah, I think there's been a theme of a lot of bark over the last few months between regulators and the industry, and I'd be surprised if the new administration proceeds with this lawsuit. And we're expecting a more collaborative, less antagonistic relationship moving forward.
So overall, a lighter touch when it comes to some of these airlines. What difference will that make for their businesses?
I think they can focus on the day-to-day operations. They're not, distracted by managing these lawsuits. There's going to be a lot less cost, associated with that compliance. So I think it's a positive.
Is it the issue of the airlines, or is it just the fact that too many people are flying and you say it's so congested?
Yeah, I think it's all of those things. I think you've had a less experienced workforce post-pandemic that is getting better every single year. It's a really crowded operating space. The airspace is more crowded. We have an ATC shortage. It's very acute in places like New York, places like Florida. So I don't think you can point to any one issue. And, I think the airlines are doing their damnedest to be running an on-time operation. That's the best way to keep your cost in line.
The JetBlue CEO recently said on this program that the regulatory environment can't get any worse after Biden leaves office. What are you expecting in the airline industry under Trump 2.0? Could we see more consolidation?
I think it's definitely on the table. JetBlue's talked about, at the very least, pursuing some type of partnership in the Northeast, whether that's with American, whether that's with United. That remains to be seen. But a lot of industry folks that we talk to think that there likely is going to be more consolidation among the smaller airlines in the years ahead.
Who's on the playing field? What kind of names are you thinking about?
It could be any of the small cap airlines. It could be a JetBlue, it could be Frontier, Spirit, tie-up, Sun Country, and Allegiant. I think it's harder to say right now, and a lot will come down to valuations and personalities. But I wouldn't be shocked if there is more consolidation in the 5 years ahead.
JetBlue's come up a few times. Didn't they try and establish a relationship with American Airlines a number of years ago?
They did, and it was approved by the Trump administration and then later blocked by the Biden administration.
So you think they have a second bite at the apple?
I think so, and the judge gave them a template of what they could do, and adopting something closer to what Alaska and American have on the West Coast as a preferred model.
Well, a lot of these models are under stress, the ones that don't have the international businesses, that don't have the premium. Bringing back around to where we started this, definitely Southwest is one of these airlines that doesn't have it. They've tried to make some changes. They're stopping hiring in some of the management levels. They've tried to have more spacious seats, more seat assignments. Are they on the right track?
It's going to be hard to do. The second half of this year will be we'll get a better idea of that. That's when the extra legroom seats will go on sale. A lot of the changes this year are more tactical and incremental, adding red-eye flying. They're going to launch a partnership with Iceland Air. But I think the second half of this year we'll have a better idea if the changes are working. But management is definitely under a lot of scrutiny and going to be in the hot seat this year.
Just as sort of a broad commentary on this industry, for those smaller ones that don't have international or the luxury offering, can they do it on their own? Can they transform on their own? Or do we need to see M&A in the industry in order for them to survive in some form or fashion?
I think there's a lot of players that M&A could make sense for. I think there's, we tell clients either go big or go niche, and there are small airlines that I think have attractive niches right now, like a Sun Country, like a SkyWest. But it's definitely a reversal of the prior 2 decades pre-COVID, where legacies bled and low cost led.
We've seen post-COVID just this insatiable demand, especially in services, people wanting to travel. Do you see that withholding in 2025?
I think so. The upper income cohorts are all doing phenomenally well right now. I'm not expecting that to pull back, and I think that plays in well with the secular theme of spending on, travel and experiences and services, to your point.
Just to build on the line of question around premium and these other airlines, can budget airlines do premium successfully? I think back to EasyJet and Carolyn McCall. I remember when McCall made it very, very easy for business travellers, and the share did phenomenally well from, I think, 2010 to around 2017. Could we see something similar happen with some of these players?
I'm a little more skeptical. I think it works really well on longer stage lengths and in big corporate markets. I think if you're catering more towards price-sensitive leisure on a short flight, I'm not sure how big the market is for that, but happy to be proven wrong.
Have you got sales on some of those names then? Because those names, and I won't name them, some of them are spending a lot of money to push into premium, and ultimately you're suggesting they might fail.
Yeah, I mean, I don't know if a failure. I mean, there's profitability challenges versus actual bankruptcy. But I think we have more hold. Some of these names are so volatile, and you have short interest approaching 20%. So if things get just a little bit better on the expectations treadmill, the stocks can start to work really quickly.
Favorite stock right now?
United Airlines.
United had a wonderful year last year.
I think they're going to have another wonderful year.
Why do you think that can continue?
Well, they were only trading around 3.5 times EPS in August, so it's not like they went from 20x to something eye-popping. And I think they're going to be growing EPS well above the S&P 500 for the years to come, and they're a really exciting company.
Does Dawson compete?
Oh, absolutely. They're another of our top picks.
Can they sort out the lounge?
Have you been
just
to the JFK?
Just make it quieter. Just make it quiet. There's too many people.
You got to get the Delta One tickets.
I know. I've got to spend more money.
Or the credit card, right?
Yeah, that. Does a credit card? Does it get you in still? The credit card points? Does it get you into the Delta One lounge?
Depends on the card you have.
Okay, Tom, appreciate it.
Thank you so much for having
appreciate
me.
it. Thank you, Tom Fitzgerald there of TD Cowen on the airlines. That place gets packed over at JFK.
I've tried to get into Delta One so many times knowing that I can't get in, that I don't have a first class seat, but I go and I'm like, I have a Delta flight, I have a card, any chance. I've literally
even worse, I had a first class seat, but I didn't have the credit card. So they said I couldn't get in.
Wait a second.
Because you were flying domestic. I forget who it was, but because it was a first-class seat domestic.
Oh, American do that with the Admiral's Lounge too.
It needs to be at least 5 hours long. It needs to be some sort of overnight flight for them to. I've done the same thing. They were like, your flight's an hour. You can't get into Delta One.
But they'll charge you a premium if you want to just sit in the lounge. I think it's ridiculous.
So, I think this is ridiculous too. Flight to Hawaii, okay? So, takes 9-10 hours. And they said it was domestic. And they turned me away from the lounge.
That sounds like a personal thing, because I don't think that's the policy. I think they maybe looked at you and were like, I don't know about this.
I'm just throwing it out there, right? It's important. They've got to fix these things, Tom. They've got to fix these things fast. In just a moment, we'll get retail sales and jobless claims, and we'll catch up with the former Fed Vice Chair, Richard Clarida, and get comments from Collin Martin of Charles Schwab. We've all got a lot of questions about CPI. Just how much does that downside surprise on inflation yesterday change the story for the Federal Reserve, if at all? Francis Donald of RBC on the programme a little bit earlier this morning, making the case that it won't. The most important thing that's about to take place is not the economic data, it's the inauguration of President-elect Donald Trump and the policy changes you could see in the days after that. Futures at the moment positive by 0.1% in the bond market yesterday. A tremendous rally off the back of that downside surprise on CPI this morning. Retracing just a little bit of it. Yields are up by 3 basis points on the 10-year, 468.38. In Europe, they've got their own problems. The ECB accounts out in the last hour or so. A discussion about deeper rate cuts. Some officials wanting a bigger debate on a 50 basis point reduction. That unlocks just a bit of euro weakness. Euro dollar down by 0.2%, 102.68. Up next on the programme, the economic data from New York City. This is Bloomberg. The next stop for this market, the economic data, is just moments away. US retail sales and jobless claims as well. Mike McKee's going to break that down for you in just a moment. Going into it, here are the scores. Equity futures on the S&P just about unchanged. On the Nasdaq 100, up by 0.2%. In the bond market, the downside surprise on CPI yesterday, unlocking a monster rally. Yields down aggressively across the curve by double-digit basis points on a 10-year. This morning higher by 3 basis points. With your economic data, let's get to Mike McKee. Good morning, Mike.
Good morning. Well, it looks like we had a good retail month, but not a great one. The anticipation was for a very strong retail sales number. It comes in at 0.4 instead of the 0.6 that was forecast. Ex-autos 0.4 as well. Ex-autos and gas 0.3. So we know there's a fairly big gasoline component to all of this. But the retail sales control group does save the holiday season, shall we say. It comes in up 0.7% compared with 0.4 the prior month and a 0.4 estimate. So it looks like the stuff that goes into GDP is the stuff that did well this time. I'll get that data for you in just a second, but we'll pass on also that import prices were up 0.1% and ex-petroleum up 0.2%. That's reasonably good news because buried in there somewhere is international airfares, and the international airfares are something that contributes to that PCE. We saw a big rise in airfares in PPI, so this will show us whether or not the PCE comes in softer or harder. Finally, Philadelphia Fed, the Philly Fed comes in at 44.3 after a negative 16.4. Major turnaround in the Philadelphia, New Jersey area. The prices paid index is at 31.9, though that comes up from 26.6. So you got an inflation signal there. You can make of all that what you want. And while you talk to Dr. Clarida, I'll look up where the retail sales numbers were good or bad.
Mike McKee, thank you, sir. You stay close. Jobless claims came in a little bit firmer than expected at 217, still exceptionally low on a historical basis. The estimate was 210. The previous number revised 203. To Mike's point, headline retail sales, the advanced month-over-month read, little downside surprise, 0.4% against an estimate of 0.6. But the one that matters for GDP, the control group comes in at 0.7. The estimate was 0.4. So the bond market gets whipsawed all over the place, and these are the scores in the Treasury market right now. Yields are a little bit higher still at the front end by 3 basis points on a 2-year, and as you were on a 10-year as well, up by about 3 basis points to 468. Euro-dollar dancing around a bit, but basically unchanged as we were going into the print, 102.66, and equity futures just about positive, down on the S&P 500.
Let's be honest, this isn't a huge catalyst, not least of which because the numbers are basically as expected. They don't change the economic picture. But if you are going to trade this, you could get whipsawed yet again in 2 hours' time when we hear from Scott Bessent and his confirmation hearing, and then get whipsawed again on Monday. So I think it's a very cautious time if you're a trader in this market, trading on economic data.
Let's speak to a man who can settle things down. The former Fed Vice Chair, Richard Clarida, joins us now for more. Rich, good morning.
Glad to be here.
It's good to see you, sir. Yeah. Let's start with the economic data, not just this morning, but of the last 24 hours. Does it change much for you?
Well, you'd like to get some good news on inflation occasionally. We've had some negative prints, and so I think it was a positive. Inflation's still running, I think, hot, but the Fed will be looking for a return to getting on that bumpy road down to 2%.
Do you think the trend is uncomfortable, or are you comfortable with the trend right now?
I'd be a little bit nervous. The Fed put a lot of weight on the fact of seasonals a year ago. Well, we had 3 bad months of data. The last 2 or 3 months of 2024, the data wasn't going in the right direction. So I do think we're on a path to 2%, but the road may be bumpier than folks thought a couple months ago.
To that point, it's been this narrative whipsaw. It's been back and forth. It feels like we're either scared it's going to be a recession or the economy is running too hot. Do you believe that the economic data is actually that uneven, that we can have such different turns in the narrative just 1 month apart, or is something else going on?
I think it's both. I think we've been through a very unusual period. We've had a lot of aftershocks from the pandemic, including inflation. We've had a lot of good news in the U.S., very strong productivity growth, a big increase in wealth, and obviously the Fed is happy that inflation has come down. So I think there is sensitivity and probably a little bit about what to expect for fiscal policy and how will the Fed react.
To that point, should we be looking all of this data at this moment just as a starting point of what we might get from policy that might add to inflation, might change growth dynamics? Is that the right lens to view everything we're getting?
I do think it is. Initial conditions are important. And so, beginning the year, the economy is growing above trend, 3%, low unemployment rate. And so I think putting policy uncertainty in the context of where the economy is, I think, where the markets need to be.
Should it be what the Fed is doing as well?
Oh, of course. Oh, everywhere and always about the Fed, right.
Well, to that point, how forthcoming should they be? And that's their estimation, that they're looking at the current data and saying, we understand where it is, but we need to preempt where it's going because of fiscal policy.
Great question. And I do think that Jay Powell made the case, especially in November, that they're not inclined to get too far ahead. There's a lot of uncertainty on the details, tariffs, taxes, immigration policy. And I think we are at a delicate point for the Fed because the minutes reveal they did start to incorporate some views on that, but I don't think they'll get too preemptive in this environment. I don't think that would be worthwhile.
Well, in November, Powell said we don't assume, we don't speculate, we don't guess.
Good quote, yeah.
But then in December, members did.
Yeah.
So how are we supposed to understand this?
Well, the minutes were very revealing and more so than usual, I think, because in fact, if you read carefully, as I'm sure you all did, not only did participants on the committee begin to pencil in some views, but the staff briefings also looked at scenarios for trade, tariff, immigration policy, but also incorporated some of that into the baseline. So they're already starting to try to factor that into the forecast, but I think with a great deal of humility.
You talk about how uncertainty is the only thing certain.
Yeah.
What are you most uncertain about when it comes to Trump 2.0?
Well, I think you look at the three priorities of the administration. What are the details on tariffs? You know, is it a bargaining chip? Is it a battering ram? Immigration policy. I think bipartisan support. We need to fix our immigration system, but the details will be important. And then the budget. Obviously, I think everyone agrees, including Pimco, that the 2017 tax cuts are going to be extended. But will there be additional tax cuts? Will there be pay-fors? How much of the Biden agenda will be reversed? And so I think you need to look at all three of those.
You're in the perfect seat, because the other question as well is whether this bond market will constrain the ambitions of Washington, D.C. How are you and the team thinking about those forces?
It's very important. You know, we were having some conversation before I came on about the bond market vigilantes. You know, the idea that if Washington's running an irresponsible fiscal policy, you push up rates, you push up term premium, and I think that'll be a very important part of the calculation. Now, bond yields can go up not just because of budgets, because of strong growth and optimism about productivity. So the Fed will have to do some signal extraction. But I think importantly, if yields sell off because Washington's running an irresponsible fiscal policy, then that's part of the way the economy needs to adjust.
What do you think the run-up in bond yields more recently has been about? The data or the incoming administration?
Well, I'm going to be the proverbial two-handed economist. I think there's an element of both. I think that there's optimism about growth, about deregulation. I think that's certainly an element of it. But there's also, I think, concerns about fiscal policy. And we saw that a year ago, and we could be seeing some of that right now.
But you've been writing that bonds are better positioned in 2025 than other asset classes. Does that mean that run-up in yields reverses? Is there going to be a catalyst to help bring us back closer to the ground?
Yeah, so our thinking is that bond yields obviously have been in a range. They've been fluctuating. But we saw bond yields reach 5% about 14 months ago, and then they retraced down. We do think there is an enormous global appetite for treasuries, and there will be a certain level of yields. Last time it was around 5%, where you start to get a lot of foreign demand. And so one of the reasons that we're bullish on bonds, in addition to being Pimco, is that starting yields are historically the best single predictor of your return on a quality bond portfolio. And starting yields now are attractive and obviously have room to adjust lower under the right circumstances.
John and I have been talking about this hour how it's getting the notice of not just individuals that are part of Trump's economic policy team. J.D. Vance talked about the 10-year yield twice over the weekend in an interview that wasn't even supposed to be financially focused. Is there a level that you think, and I mean, you know Donald Trump, that really starts to unnerve him?
Oh my goodness! Well, I wouldn't speculate on that. What I would say that markets would be focused on, let's sort of simplify it, is, you know, the peak in 10-year yields so far in this cycle has been 4.99%. I think maybe for a minute we got above 5. So certainly if rates, 10-year yields broke above and stayed above 5, that would get a lot of attention around the globe, in the White House and at the Fed and in markets.
Can you help me with something? Because I've got a little bit of a dilemma. I'm trying to figure this out. You were on the Federal Reserve back in the early 20s. So the end of 2021, I've got the minutes in front of me. I've got the SEP in front of me too. Yep. December 21, the outlook for the Fed funds rate, the median for 22 was 0.9. Yeah. And you ended up hiking interest rates all the way up to 4% at the end of 22.
Yeah.
And this was after President Biden had already unleashed stimulus into a supply-constrained economy. This was after even inflation was climbing up to 5%. The Fed sat there at the end of 21 and said, maybe rates get to 1%. And look at the range of estimates as well on the FOMC. It's really narrow, too. It's anywhere from 0.4 to like 1.1. So it's not like there was some outlier there pricing in a policy change in Washington. Why does it feel different this time with Trump coming back into power? Why was this Federal Reserve and some officials more willing to adapt their outlook, adjust their outlook on policy changes from Donald Trump when they were unwilling to change, even though they'd seen what was coming from Biden? What explains that, Rich?
Well, look, in my own writings and on this show, I've talked about, what at least I was thinking in real time. And certainly by that point in 2021, the Fed had realized that it needed to begin to end QE to start signaling rate hikes. I think there was also an assessment as well about, on the committee and a range of views on the committee, I'll leave it at that, about how transitory inflation would turn out to be. So there's no doubt that in retrospect, the Fed would have been better off beginning to hike rates in the fall of 2021. I think what you need to look at is September versus March of 2022. You need to look at the result and well-anchored inflation expectations. But it was a challenging time, John, not just for the Fed, but also for central banks around the world. The pandemic, the shocks, and the policy response, it was difficult to navigate through.
I think we all just want to be sure that it was just an analytical mistake and not a consequence of political bias.
Oh, I'm certainly not, in my judgment, a consequence of political bias.
Because it is odd that in November the chairman says one thing and then in December he has to say another. And I'm still struggling to explain to people just what changed in between.
Well, again, it was a rapidly evolving situation in terms of the data and in terms of the assessment of the economy. And again, the Fed only meets 8 times a year, so a lot happens in between meetings as well.
Rich, appreciate your time.
Thank
Always
you.
Fantastic to catch up. Richard Clarida there, the former Fed Vice Chair. Equity futures right now on the S&P 500 just about unchanged. On top of the economic data, Mike McKee, retail sales and jobless claims out just moments ago. Mike, you've got a second look. What do you see?
A couple of interesting things, John. We saw a rise in motor vehicle sales and fall in building materials. Gasoline prices were up. That added to retail sales. But you have to take those out to get to that control group. And in the control group, pretty much everything was up. We saw a big rise in grocery store sales, in general merchandise sales, in sporting goods even. The only thing that was really down, health and personal care. I guess you skipped your haircut, John, during the month. And then when we look at jobless claims, I know people are going to be looking to see what the California impact is. California reported 13,000 extra over last week jobless claims during the week. That's on a not seasonally adjusted basis. But that's one reason that we did see the number go up some, is because this was there were more jobless claims expected than the seasonal factors figured. And then one last thing, the air passenger fares up 10.6%. That'll add to PCE. So overall, a lot of details under the hood, but in general, a pretty good day.
Mike, thank you, sir. Appreciate it. Yields are higher by 2 basis points at the front end of the curve. On a 10-year, up by a basis point or 2. Collin Martin of Charles Schwab is with us now for more. Collin, a question we've lent on repeatedly through this morning. Does the CPI print of yesterday really change the story for you?
No, it doesn't, John. And I've heard a lot of the speakers this morning. We're pretty much in the same camp, where it's a step in the right direction, but it doesn't change our outlook right now. It's one report, and that doesn't necessarily indicate a trend. If we look at yesterday's report, it was good news, of course. One thing that we're focusing on was that core CPI monthly print at just 0.2%. That was a nice improvement after 4 straight months at 0.3%. But again, that doesn't change anything right now. I don't think it changes the Fed's view. We'll need to see multiple reports like that before the Fed maybe believes that disinflationary trend has resumed. But once we get to that point, we're already into the second quarter most likely. And when you look at Fed expectations for the first cut coming in the second half of the year, that doesn't change the timing too much. So as it stands today, we're still looking at anywhere from 0 to 2 cuts this year. And the first cut in the second half of the year still seems likely right now.
Does that mean, Collin, a 14 basis point fall in the 10-year yield yesterday, is that something that you'd want to be pushing against at this moment?
We wouldn't necessarily be pushing against it. What I thought was interesting with the drop in Treasury yields was that we didn't see that much of a change in the implied Fed funds futures market rate. I think we're just going to see a lot of volatility. We're in this really sensitive period of time right now with the sticky inflation we're seeing, coupled with the policies from the Trump administration that just throw so much uncertainty. So I think the markets are really walking on pins and needles right now, and every good or bad report is likely to send yields in one direction or not. We think that we'll probably see a Treasury yield, the 10-year Treasury yield, trade in some sort of range, maybe 4.5% to 5%. We do think there is upside from there. So we wouldn't necessarily be changing our view on, a 5, 10, 15 basis point intraday move.
Collin, we've been talking about the volatility of this bond market to economic data, the sensitivity to it for some time. But something is different in 2025. We're not just talking about the sensitivity to economic data. We're talking about the sensitivity to policy, to fiscal policy. What implication does that have? Not just for the bond market itself, but if it's placed in a portfolio, an asset class that is supposed to be a staid haven in an otherwise maybe risky portfolio if you've got equities and credit in there too.
Yeah, it definitely makes it a bit more challenging to invest today, given the volatility we've seen. And when we talk about what our guidance is in this market right now, especially with all that uncertainty, again, that's a term that a lot of the guests this morning have been using, are you looking to invest from a tactical standpoint or from a strategic standpoint? From a tactical standpoint, it's difficult to get too excited about long-term bond yields right now because we do think there's upside. We think the 10-year Treasury yield probably will touch 5% at some point. I think that's going to be driven by a combination of expectations for the path of Fed policy, but also the term premium, given where it is right now at close to 70 basis points. But from a strategic standpoint, and I want to piggyback on something that Rich Clarida was talking about, the starting yield matters. So something we're talking about with our clients at Schwab are those income payments that you can earn. And whether the 10-year Treasury yield is 4.5%, 5%, 5.25%, we know that the yields right now are attractive to help a lot of investors reach their goals. So we think there is upside. I want to make that clear. And we do favor a benchmark or below average duration. But just because of that potential upside to Treasury yields, we don't want that to necessarily scare investors away from the bond market right now.
Do you think we're going to get any clarity on Treasury issuance and where you think this administration has almost a line in the sand when it comes to Treasury yields today from Scott Bessent as he has his hearing on Capitol Hill?
I don't know if we'll get much clarity there. I think that's going to remain a question mark. Treasury issuance is going to be a challenge right now. I know there's this whole talk about shifting the maturity makeup, but that can have implications. If you want to start issuing more long-term debt in anticipation of potentially higher yields, you need to find demand there, and that poses a risk in and of itself. And then again, piggybacking on discussion earlier, we know that Trump likes lower interest rates. So how does that play into the path of proposed policies and the magnitude of that implementation? So I think there's just more uncertainty, and I wouldn't expect any clarity today.
Well, this is what is so hard to understand. Donald Trump wants lower interest rates, but everyone says the policies he's talking about may mean the Fed has to remain on pause. Do you think that the fact that he wants lower interest rates and that if that ends up becoming his North Star, that actually he'll want to front load certainty?
That's a great question, Emery, but who knows? I mean, there's really so much uncertainty, and I don't mean that to be a cop-out answer. But he's campaigned on these set of proposed policies, and any way you slice it, they tend to have an inflationary tilt, depending on the timing, the magnitude. And so how does he square that with the potential rise in yields, which we know he doesn't like, with policies that he has campaigned really hard for? And even now, in the weeks that have followed, he's kind of doubled down and said, no, this is what I want to do. So if anything, that just leads to more uncertainty, more volatility. We talk about that term premium right now. It's meant to compensate for uncertainty, and that could be something that ends up pulling yields a little bit higher in the near term.
Collin, appreciate it, sir. Thank you. Collin Martin there of Charles Schwab. I think that's got to be the point of tension in today's hearing, that some of these policies will lead to the kind of things that ultimately Scott Bessent might complain about.
Yeah, exactly. When it comes to things like the issuance, and also when it comes to things like, remember, Donald Trump has a real estate background. This is a guy from New York who wants low interest rates. How many times was he jawboning Jay Powell in his first term? So you need some certainty then if you want the Fed to potentially move on where the economy is. But the Fed might just stay on pause because they're so uncertain about his policies.
I remember a number of months ago, Marko Kolanovic said something important. He said that Scott Bessent's biggest challenge won't be enacting policy change. It will be managing the market fallout that might undermine those changes. And the Treasury market's got to be top of mind.
Well, this is why when it comes to things like issuances, it needs to be regular and reliable, because part of the problem is at this moment, one way to think about things is we know that a change is going to happen. We have a change administration, we have different policy, and we know said change will have an effect, but we don't know exactly what the change will be, and we don't know exactly what the effect will be. That means you just have to price in a higher premium. To Collin's point, if there's more volatility, you need to have a higher premium. I don't know how Scott Bessent gives us that certainty when ultimately it is Donald Trump that's going to have the final say on these policies.
Bond yields up just a little bit this morning by a few basis points. With an update on stories elsewhere, here's Yahara Hackers. Hey, Yahara.
Hi, John. Let's recap all that data we just got. Retail sales slightly missed during the holiday shopping season, rising 0.4% in December. Economists were expecting a 0.6% rise in spending. Meanwhile, initial jobless claims coming in at 217,000, slightly above the expected 210,000. Meanwhile, Israel and Hamas have agreed to a 6-week ceasefire starting this Sunday. Under the terms, Hamas would release 33 hostages and Israel would pull out of populated areas in the Gaza Strip and release hundreds of Palestinian prisoners. But Prime Minister Benjamin Netanyahu's office is accusing Hamas of reneging on parts of the agreement and saying his cabinet won't meet until Hamas accepts all points of the deal. And some respite for fire-ravaged Los Angeles. The low humidity and dry winds that have fueled the wildfires are forecast to end by midday today. However, strong winds are in the forecast for next week and still no chance of rainfall. The two largest fires, the Eaton and Palisades, have become among the most destructive in California history, leaving 25 people dead and scorching more than 37,000 acres. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, we'll bring you the trading diary, the calendar for the day ahead and a week ahead. Three-day winning streak on the S&P. Let's see if we can make this day 4. We're positive by 0.1% on the S&P 500. Your trading diary looks like this. At 10:30 Eastern, President-elect Donald Trump's Treasury Secretary nominee Scott Bessent on Capitol Hill. Friday, housing starts and building permits. Monday, Trump's inauguration and the World Economic Forum begins. On Tuesday, earnings from United Airlines and Netflix. On Thursday, a little bit more economic data.
So what I hear about, Jonathan, going up to Capitol Hill, having this hearing is like going to the dentist, but only got to do it once in terms of, getting your wisdom teeth pulled. What I will say about Scott Bessent is this is someone that has the backing of the MAGA core, like Steve Bannon, and yet financial industry titans like Stanley Druckenmiller. I think he's going to be able to handle this hearing. We need to know about policy, though.
Let's hope it's not that painful for Scott a little bit later. Coming up tomorrow, reacting to all of this, Erica Najarian of UBS, Jim Karen of Morgan Stanley, Steve Risciuto of Mizuho, and Phil Camporelli of JP Morgan. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.